Hello, good morning. Hello. Good morning, everyone.
Good morning, sir.
Good morning. Good morning, Sahil. Good morning, Atish. Good morning, Vivan. Pranati, Soho. Good morning. Good morning, Mitten. Good morning, good morning. Good morning. Chalo. Today, we will do consolidation. We'll do MPM. We'll do IFRS 19 and IFRS 18. Chalo. When coming to these standards like your IFRS 18 and IFRS 19, I have sent you already questions, and in your practice exam also you have one question regarding MPM, and then ACCA Study Hub also you have questions. So please do those. And for this attempt, as mentioned, this is the first attempt where IFRS 18 and IFRS 19 will be tested. So the questions will be straightforward. But regarding MPM, any APM will be given. Let's take any APM or MPM will be given. You have to justify whether it's an APM or not as per IFRS 18. So now, let us start today with consolidation. We'll be doing the consolidation, FR basics as well as SBR, and the important points I'll be saying and what are the questions that can come and the important adjustments. So let us start with consolidation. Now this consolidation is very important for your SBR. Question number 1, 30 marks. Now out of 30 marks, understand that out of 30 marks, 12 to 14 marks will be adjustment. And in the 12 to 14 marks, 6 to 7 marks will be repeated in P&L, in balance sheet and cash flow. And then coming to the other 14 to 15 marks, in that 6 to 7 8 marks, 6 to 8 marks will be a theory question from consolidation most of the time we have seen. And then the other 6 to 8 marks could be 4 to 5 marks could be regarding some theory regarding consolidation or some standard, or one more question could be there regarding some standard like IAS 19 fair value. Then you can have IAS 12. We have seen this. So now chalo, let us start with consolidation. The first standard which will be covering here is IFRS 3 business combination. To do consolidation, it should be a business. The first important question that is important in your exam is whether we are acquiring a business or whether we are acquiring a asset. Then IFRS 10, consolidated financial statement. You have to prepare consolidated financial statement. Then IFRS 11, joint venture, a very important theory topic again for your section A. Question number 1, whether it's a joint operation or joint venture. Then in IFRS 10, what is the theory question? Control. Whenever these question comes, so please write down the technical knowledge as given in the standard, because the marks are very high. In the first question, the technical marks are very high. When coming to control, if you just write down the definition, you get 3 marks. When writing the business, what does business mean? 3 to 4 marks. Then IFRS 12 disclosure, not so important. IFRS 19, very important, the new topic. Then IAS 27, separate financial statements. This also has been tested a lot of times for 4 to 5 marks, and it's very easy, straightforward. Then IAS 28, investment in associates and joint venture. These are the standards which we will be covering under the consolidation. So first, starting with the definition, some important terms we have to understand. The definition, what is a business combination? So consolidation, there are two standards, IFRS 3, IFRS 10. Understand when IFRS 3 will apply. IFRS 3 will apply on the day we acquire the company, and at each reporting date, IFRS 10 will apply. The example which I had given in the class, I mentioned that if you purchase a new car or new iPhone, you click a photo and put a status on your WhatsApp today only. So this means what? It's IFRS 3. But after every 2 months, 3 months, or after 1 year, You keep on reposting the same picture with, let's take you purchased a car, you're going out somewhere, and you repost the picture saying that I have this car, I'm going outside, etc. To remind, in the same sense, IFRS 3 will be followed on the day when we acquire the business, IFRS 10 at each reporting date. Then coming to business combination means a transaction or other event in which the acquirer obtains control of one or more business of the acquiring. So in this, there are three important terms, and from these three important terms, question will come regarding theory. You have to identify which company is the acquirer, what does control means, whether control is there or not, and whether it's a business or not. So business combination, a transaction where one party obtains control over one or more business. So now the investor is known as parent company. It is also known as the acquirer, an entity which controls one or more entity. Subsidiary, investee or acquirer, an entity which is controlled by another entity. What does a group means? Group means parent and subsidiary together. Acquisition date means the day when we obtain control. Consolidated financial statement means parent company and subsidiary company, we prepare one individual financial statement, keeping in mind that it's a single economic entity. It's a single economic entity. Whenever a question comes regarding IFRS 10, so please write down this, that the financial statements of a group, if a theory question comes, group present those of a single economic entity. Then non-controlling interest means what? If I say today a parent company is that a subsidiary company, parent has 70%, that means this is a controlling part. The 30% is what? Non-controlling part. These 30% shareholders do not have control, so these will be known as NCI. Now this is clear to everyone. Now before that, this should be clear to everyone. The screen is blur, no? Yes, 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 yes. Clear, yes, 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 but it will create a problem because it's a one single page. That is the reason. Let me shift to one note only. Now, I hope everyone can see the screen. So see here now. First, you have to understand this flow chart which I've drawn here. Types of investment. If the investment is less than 20 percentage, it will be covered under your IFRS 9 equity investment. Then 20 or more, but up to 50 percentage as per IAS 20, it will be an associate. More than 50, IFRS 3 and IFRS 10 will apply. For joint venture, you have to see it's a joint operation or joint venture. If it's a joint operation, IFRS 11 will apply. If it's a joint venture, IAS 28 will apply. So now let us start with the first theory topic, that is control. What does the term control means? Control means what? When we'll say an investor controls an investee, when in investor has all the three things. Control means power to direct relevant activities. What is the first thing you'll write down? So control will be when the control investor will have control when it has power to direct relevant activities, exposure or right to variable returns, ability to use the power to affect the amounts of return of the company. So now what does power means? Power means power can come through voting rights, appointing the board of directors, removing the board of directors, decision making, etc. A lot of it. What does relevant activity means? Relevant activity means selling or purchasing of a PP, raising of finance, whether to which assets should be disposed, whether the funds in which business it should be invested, a lot of things. Now, sir, what is exposure or right to variable return? Uh, you also, if I have a control, if I say if the company is making profits, I also will make profits. If the company is making loss, it will be a loss for me. So, exposure or right to variable return, I have right over variable return, not fixed returns. Then ability to use power to affect the amount of return, that means I have the power so that I can change the decision. If the company is doing business in one sector, I'll say that shut down this and do the business in other sector, so it will be more profitable. In that case, the profit of the parent also will be affected, the subsidy also will be affected. So we say we have control. Now what are the other factors to assess whether the investor has a power over the investee? Exercise of majority voting right, contractual agreement between the investor and other parties. If today I have only 40 percentage, but I have one of my friend who has 10 or 20 percentage, I do a contract with him saying that whatever I say you should agree. In that case also we say I have control, even though 40 percentage, but other 20 percentage is with my friend and I have done an agreement with him saying that whatever I say you should agree. The next one, holding less than 50%, the percentage is less than 50 percentage, but the other shareholding is with the shareholders, and these shareholders are all over the world and they're not able to connect, and each of them have less than 2 percentage, 3 percentage, etc. xyz. Then holding potential voting rights, convertible loans, that means today the company has issued a convertible loan notes and you have the option to purchase the shares at the end of third year or fourth year. Let's take, and these options are in the money. If they are in the money, we say that power is that. That means the market value is more, the exercise price is less. Then the nature of investor relationship. How is the investor's relationship with other parties on the board, etc. XYZ. So with this, the definition of control is done. So it is very important topic. Whenever a question comes, please write down these three and write down what is relevant activity. In most of the question, what is relevant activity? How will power, will there be power or not? It will be mentioned in the question. So link to the case and write down your answer. Then coming to the next important theory question, business. Whether the company which we have acquired is a business acquisition or it's an asset acquisition. If it's a business acquisition, we follow IFRS 3 and IFRS 10. If it's an asset acquisition, the company will normally record that we have purchased an asset. So what does a business means? Business means an integrated set of activities and assets that is capable of being converted and managed for the purpose of providing goods or services. In a basic sense, that means what? That should be what? That should be an input, that should be a process, and that should be output. Output means what? Goods or services to the customer, investment income, or any other income from the ordinary course of the business, as well as any other income other than the ordinary course of business. Now, sir, to be a business, if it meets the definition of business as per IFRS 3, it's a business combination. We will do and we'll follow consolidation IFRS 10 after that. So if it does not meet the definition of business, then it's a asset acquisition. Asset acquisition, how will you record? Normal, like you purchase a PP. Note, a business consists of input process that have the ability to generate output. It's not compulsory that output should be there. Input and process should be strong so that the output will be generated in future. It means output is not required for integrated set of activities and the asset to qualify for the definition of business. To be considered a business, an integrated set of activities and assets must include at minimum an input and a substantive process. To be a business, minimum what should be there? An input should be there and a substantive process should be there. Not just process, it should be substantive. That together significantly contribute to the ability to create output. Now, what are the examples for input? The example for input is raw material, PPE, right to use asset, intangible asset, etc. Process means a system, a standard, a protocol, a convention. What are the examples like operational process, strategic management process? So there should be a way so that this input can be used and the output can be generated. So understand, a process requires employees. A process will require employees. Understand that. So input should be there, process should be there so that we can generate output. And output is the result of input and process applied to those inputs that provide goods or service to customer, investment income, or any other income other than the ordinary activity of the business. So this is the definition which you apply and you can write down your answer. No issues in that. But IFRS 3 provides a test known as concentration test. This test is optional. If the company wants to apply, they can apply. If not, they can directly apply the definition of business which is given as per IFRS 3. So see now, IFRS 3, this is an optional test, concentration test. If this concentration test is satisfied, that means it's not a business. It's not a business. If concentration test is not satisfied, it's a business. But you have to see further thing. You have to see whether output is there or not, whether output is there, output is not there. See on a simplified assessment. Does entity want to apply this concentration test? No, then general guidance which is given as per IFRS 3 regarding business you have to apply. If the company is saying that we will apply, in that case, what should we do? Is substantially all of the fair value of the gross asset acquired, concentrated and single identifiable asset. Now, what does identifiable asset means? Identifiable we cover in IAS 38 that it can be separated from the business and can be sold or transferred or licensed or it arises from a legal contract. A very important. We have seen a lot of time question coming whether it's an identifiable asset or not. We will do that also theory question. Now, if I say when I'm paying any amount to acquire any company, in that case, the amount which I pay, the fair value or the premium which I pay only belongs to one particular asset. In that case, I say that I'm not acquiring a business. The test is satisfied. It's not a business. If the amount which you pay, the premium which you pay, is not allocated or is not concentrated on a single identifiable asset, no. But if it is concentrated in a similar group of identifiable asset, in that case also we say test is satisfied. Then it's not a business. The concentration test is satisfied, it's not a business. If I say concentration test is not satisfied, it can be a business. You have to do further assessments, Test is not passed, further assessment to be made. So what is the further assessment? Is acquired process substantive or not? So one important thing which you have to keep in mind is what the process should be strong enough. If I say today, if I acquire any company, I acquire the activities and the asset and does not have a output. Today I acquire a company. Let's take I've acquired a startup. And as of now, the startup does not have any output. But I say the input and the process is very strong that in the coming 3 months or 4 months, output will be there. Output will be there. So when we say the process is substantive, when the input and the output should be very strong, then we say output is there. So the process is critical to develop or convert an acquired input into output. And input acquired includes both. Input should include what's an organized skill workforce and other inputs that the organized workforce could develop or convert into output. Simple thing. Organized skill workforce should be there. If output is not there, you should have a very good team. In that case, we say we know that for sure output will be there. If I say if a set of activities and asset has output at the acquisition date, today you acquire a company and output is there. Okay, no issues. But the output which you're generating should continue for the foreseeable future, as well as the input and the process which you have should also be strong enough so that it continues to produce output in the coming years. So the process acquired is substantive only if process is critical to continue producing output, and input acquired include an organized workforce with skill and knowledge to perform the process. Even though you have output, you should still acquire employees, and the employees should have some skills and knowledge so that they can use the process and continue to produce output. If you have purchased the company, you have purchased the process, and you have not purchased the skilled workforce which are required for this industry, then it's not a business because you do not have the ability to generate output in the future. Today it is there. Once you acquire and you say that I do not need the employees, in that case it's a problem. Now, the other way around, process significantly contributes to the ability to continue producing output and is considered unique or rare, or cannot be replaced without significant cost, efforts, or delays in the ability to continue producing output. In this case, if you do not have skilled workforce, no issue. But the process or the input, the process should be in a such a way that it should be able to work automatically, like in technology, business, etc. We can consider it. But the basic point which you have to remember in the exam is what? Input should be there, process should be there, output should be there. Even though output is that today, the input and process should be strong enough so that in future also the output will be produced. Now see, a business acquired need not include all the input or process that the seller used in operating that business. If I'm acquiring a business today, let's take Reliance have a lot of subsidiaries. Out of that, a lot of 4 to 5 businesses they have. Out of that one I'm purchasing. It's not compulsory that I purchase the overall business. If I'm purchasing a part of the business and that part of the business has input, process, output, no issue. It becomes a business combination. So I hope the definition of control is clear and the definition of business is clear to everyone. An important thing. In exam, you will not be able to write this detail. So just write down what does input means, process means, output means. You will have 2 marks. And write down that it's not compulsory to have output. The process and input should be strong enough to generate output. Then coming to the next one. IAS 27, separate financial statements. So what does separate financial statement means? Understanding. This is Reliance company. In the class, we have taken this example, Reliance and Jio. Now, Reliance company will prepare what? It's in the Reliance company will prepare its financial statements. Jio company also will prepare its financial statement. These financial statements are known as what? Individual financial statements. Individual financial statement. Now, I say Reliance acquired Jio 70%. Then what will Reliance do? Reliance will show in its balance sheet that investment in Jio. Once if they show investment in Jio, and Geo company show anything? Nothing. Geo company will say that we have received the cash. Simple. So this financial statements will be known as what? Separate financial statement. Separate financial statement. Then when Reliance company will prepare known as consolidated financial statement, assuming that Reliance and Geo is one single entity. One single entity. So for this you follow IFRS 3 and IFRS 10. For this, you follow what? In separate financial statement, we follow IAS 27. IAS 27. So now, why will the company do consolidation? A basic thing which I mentioned. Consolidation is done to show is done. Consolidation is done to show power in the market or to do show off. Simple. So now see here, IAS 27 separate financial statement. Now this investment which we have recorded, no, can I say this Reliance has recorded an investment? Now, this how will the company record it in its separate financial statement? Individual financial statement means there is no such investment. Once there is an investment, they follow normal IS and IFRS as well as they follow separate financial the IS 27. So it becomes separate financial statements. So see here now, in separate financial statements, how will the company record? Investment in a subsidiary, associate, or joint venture can be carried in the investor's separate financial statement either at cost, either they can record a cost, fair value, that is as per IFRS 9, fair value through P&L, fair value through OCM. Then equity method as per IS 28, equity method as per IS 28. So now, if the investments carried at fair value under IFRS 9, both the investment at fair value and the revaluation gain or loss on the investment must be cancelled on consolidation. Normal. If you're following fair value method, if you have recorded any gain regarding this, when you do consolidation, you remove the investment in Reliance share as well as you remove the fair value. I have not seen this adjustment in SBR exam. So, but remember, if it comes by chance, you can do it. Dividend received from the investment will be recognized when the investor's right to receive the dividend is established. Normally, in your separate financial statement, if you receive dividend, you will record it. We have received the dividend. Now, see, at cost or IFRS 9, dividend income will always go to investing category in separate financial statements. Equity accounting, dividend will deduct from the carrying amount of the investment. Yes or no? You are IS 28. What do? If you receive a dividend, you remove from the carrying amount of the asset. In your exam, this is the frequently tested adjustment. The examiner will do what? The examiner will just write down that you have received this dividend. In that case, you have to remove the complete dividend. You should record the profit that belongs to the company and then reduce the dividend part. So I hope this is clear to everyone. IS 27. Now coming to IFRS 3. IFRS 3 says what? IFRS 3 says that you have to follow acquisition method. Now acquisition method means what? Identify the acquirer. Which company is the acquirer? That means which company is the parent. Determine the date of acquisition, the day when you obtain the control. Because we should determine the date of acquisition. From that day, we'll start following IFRS 3 and IFRS 10. Then fair value of the consideration paid or transferred. What are the consideration you have paid? Then recognition and measurement of identified net asset. A lot of times this part is tested. Then measurement of NCA. How will you measure the NCA? Two methods you have. Then recognition and measurement of goodwill or gain on bargain purchase. How will you treat this? How will you calculate goodwill? How will you record gain on bargain purchase? Then coming to the next, identification of acquire. The third important theory question. Now a lot of times you would have seen that I say if you receive this question, you are very lucky in the exam. Very lucky. Identification of acquire. You just have to identify which entity is the acquirer. Normally, acquirer is the entity that obtains control over the business of the acquiring. Basic sense. In our example, Reliance and Geo. Reliance had control over Geo. Now see now. If acquisition is through payment of cash or transfer of asset, that means I am Reliance, you are Geo. I am paying you. That means I am paying cash here. So I will be the acquirer. In case of cash payment or any other asset is given for the acquisition of a company, no issue. But the issue will come in what? If acquisition is through issue of equity instrument, that means the company is issuing equity instrument. This creates a problem. I have also not seen a question regarding this topic saying that Reliance company is there, Geo company is there. Now Reliance company has acquired 80% shares. Now to acquire this company, Reliance company has done what? Reliance company today had 10,000 shares. To acquire this company, Reliance company has given 9,000 shares. So what will happen? In total, can I say Reliance company has 9,000 shares? Out of this 9,000 shares, 19,000 shares, 9,000 is with whom now? Geo company. So if you do 9,000 divided by 19,000, it becomes to 47 percentage. So that means sometimes it can be more than 50%. That means Geo company can have more than 50 percentage shareholding. In that case, Geo will become the parent company. I have not seen this type of question, but in your exam, the question will be very easy and straightforward. So see now, what are the factors? These are the 5 to 6 points which will be given in the question. Just identify and write down the answer. Factors. Acquirer is the entity whose owner received the largest portion of voting right. Normally, acquirer is the entity which received the highest voting rights. Acquirer is the entity whose owner or organized group of owners hold the largest minority voting interest in the combined entity. That means when coming to the combined entity, the acquirer is the entity with can make a contract with small shareholders or small investors and will have a great number of or the highest number of voting rights. The next one, acquirer is the entity whose owner has the power to compose the governing body. That means the entity will be the acquirer if it has the right to set the board of directors. It can appoint majority of the board of members. Then we see. Yes, better, yes. Acquirer is the entity whose previous management dominates the management of the combined entity. When it's a combined entity, which management dominates? whether entity A dominates or entity B board of director dominates. In that case, we say it's an acquirer. Then acquirer is normally the bigger entity. 99.99% it be the same only, that acquirer, the entity will be a big company and it will acquire a small company. It's never that a small company will acquire a big company. It can be. Acquirer is the entity that pays premium over the pre-combination. In your exam, this is the point which will be tested. Combined part, board of director, and this one, the first one. 4 points will be given in the question. Here and there they will twist it, identify it, and write down this company is the acquirer. So with this, we have completed one more theory question regarding how to identify whether the companies are acquirer or not. Then determination of date of acquisition. You should determine date on which the acquirer obtains control over the acquiry, date on which goodwill is calculated, income and expenses are consolidated. Then fair value of the consideration paid and transferred. What are the types of consideration? Cash consideration, deferred consideration, share exchange, contingent consideration. You cover this in your F7. The new is what here? Replacement share based scheme. So see here now, identifiable, we will cover this in detail later. So now see, identifiable assets and liabilities. Whenever we acquire any subsidiary company, what should we do? We acquire at the fair value. So whenever you get a theory question, please write down that in case of IFRS 3, when we acquire any company and prepare the consolidation, we acquire the assets and liabilities of the company at fair value. So see now, sir, should we record the assets and liabilities of the your subsidiary company? Yes. To record, it should meet the definition of conceptual frameworks here. Acquiring assets and liabilities must meet the definition of assets and liability as per conceptual framework, must be exchanged as part of the business combination, recognized even if not recognized by the acquirer, like self-generated intangible asset. What will Geo company do? Geo company will not record any intangible asset in its book because they will say we are not able to identify what is the cost. The cost cannot be measured reliably. But when I purchase it, I will know what is the cost I am paying for that brand. So in that case, internally generated brand is not recorded in individual books. But when I purchase what? When I purchase a subsidiary, in that case, I will record the brand that belongs to the subsidiary. And now if I say a subsidiary company, this subsidiary company has a goodwill and in its separate financial statement, and this is Geo company, this is Reliance company, and Reliance company is saying that we'll prepare consolidated financial statement. If Geo company has not recorded any intangible asset, we have to record it because they will say that Geo company will say that we were not able to measure the cost. Now when I acquire, I know the cost, so I'll record it. And one more thing, if Geo company has a goodwill which belongs to some other company, that goodwill will not be recorded because it's not identifiable. This also comes in your exam for theory. So see now, measurement. Acquirer assets and liabilities are recognized and measured at fair value. IFRS 13 on the date of acquisition. Yes, sir. Now, intangible assets. All intangible assets are recognized at fair value apart from goodwill if they meet the definition of assets and are identifiable. It should meet the definition. It should meet the definition. Then only we say it will be recorded. Then for contingent liability, normally what do we do for contingent liability? Geo will do what? Geo will just provide a disclosure. But when as a parent company I acquire a Geo company, what should I do? I should consider this contingent liability as a provision. I should do the accounting treatment. Normally, subsidiary company would have just disclosed it. We have to record it as a provision liability. And this will affect your step number 2 if you know the net asset value. IAS 37 contingent liability not recognized. Contingent liability of acquiry is recognized in the consolidated books if present obligation from past event and fair value can be measured. See, you should be able to calculate the fair value and obligation should be there. In this case, if it is a possible obligation, will you record it? Possible obligation will not come into picture. Only present obligation will come into picture. Understand that. We have learned two definition of contingent liability. In your exam, I have not seen this detail. Directly, it will be given. Record it simple. If a question comes by chance for 3 to 4 marks, explain. Then you have to write down that that should be present obligation and fair value should be can be measured. Liability will be recognized even if outflow of resource requires to settle the obligation is not probable. Even though it's not probable, yes or no? If present obligation is there, past event is there, and outflow is not probable, then what we do? We record this as a contingent liability in individual books. But when we do consolidation, what should we do? We should record this as a provision. Subsequent recognition treated as per IAS 37. Once you record the provision, subsequent treatment or at each reporting date, what we do? We estimate the value. So then, this no need. This one, IAS 12, deferred tax. Yesterday we have done in detail. I mentioned very important for your adjustment in SBR because this is the new part which you learn in SBR. So what is this now? Can I say when we do consolidation, when we do business acquisition, can I say we acquire at fair value? But will tax authorities believe in the concept of consolidation and fair value? They never believe in that. So you will have a fair value and you will have the carrying amount. This carrying amount will be what? As per the subsidiaries book. If it is not given in the question, it will be always as per the subsidiaries book. So what we do, we compare this. If there is a fair value gain, it will create a deferred tax liability and it will be adjusted in the net asset and the goodwill will increase or decrease. Same way will apply for if the fair values reduce. It will create a deferred tax asset, it will affect your goodwill and it will affect your net asset calculation. Understand that? Any doubts still here? Important points we have done till now. Now sometimes if you're very lucky, I say that these three topics can come in your exam for your theory, not more than 4 to 5 marks, not more than 4 marks. Exemption from preparing consolidated financial statement. So there are some exemptions that a company need not prepare its financial statement. When? See here now, a parent company is there, this parent has a subsidiary. Now can I say this subsidiary will also have a subsidiary? In that case, this subsidiary will become a parent. Now, this parent company will prepare consolidated books. Can I say this parent company also should prepare consolidated books? So that means two things will happen. This parent will prepare consolidated books. This parent will prepare consolidated book. Now, this entity need not prepare consolidated book. No need to prepare consolidated books. No need to prepare consolidated financial statement. When criteria should be met. Criteria should be met. See here now. What are the criteria? A parent need not present consolidated financial statement provided all the conditions apply. That means this is a parent company now. Can I say this is also parent? This is also parent. Let us see now. It is wholly owned or partially owned with the consent of the NCI. That means, can I say this is a wholly owned subsidiary? This is a wholly owned subsidiary of this one? Yes, sir. Then its debt or equity instruments are not publicly traded. It should not be publicly traded. Then it is not in the process of filing its financial statements. It's not in the process of filing the financial statements with a regulatory organization for the purpose of publicly issued financial statement. That means it should not be listed on the stock market. It should not be in the process also to be listed on the stock market. Then the ultimate or any intermediate parent produces financial statements available for public use that complies with IFRS standard, including all subsidiaries. Now, if I say this is a parent company, now can this parent company avoid to prepare consolidated financial statement? You have to meet four conditions. You have to see whether the debt or equity instruments are listed, whether it's in the process or not, whether it's is this wholly controlled or partially controlled by any other company? No, sir. That means this company have to prepare consolidated financial statements. But now coming to this company which is a parent, can I say this company is a parent? Can I say this company is a parent? Can this company avoid preparing consolidated books with this subsidiary? Yes. When? If it is not listed, it should not be in the process also, it should take the consent of the NCA, and it should be partially or wholly owned subsidiary. Can I say either it could be partially or wholly owned subsidiary? Yes, sir. It is owned by someone else. And its ultimate parent, can I say the ultimate parent is here P? This P is preparing the consolidated books assuming S, and this assuming this S. So this parent company is doing what? The parent company is preparing the balance sheet and P&L, that is the consolidated financial statements, for keeping in mind both the companies and as per IAS and IFRS. It should not be as per other accounting standard. It should be as per IAS and IFRS. So I hope everyone have understood this small part which comes for theory, 3 to 4 marks. I say if you're lucky, you can get this. The next one, exclusion of a subsidiary from consolidated financial statement. One more question which comes for 3 to 4 marks. Now what can happen? So see here now. Exclusion of subsidiary. What will happen sometimes? This is the parent company. This is a subsidiary company. Now, parent company has a control over this. But parent company is into manufacturing business. The subsidiary is into education business, edtech. Now, this parent company will say that we will not prepare consolidation because the business line is different. Or sometimes parent will say, okay, this subsidiary is making losses. We will not consolidate because the consolidated financial statements will take an impact. The value will be reduced or the profits in the consolidated books will be reduced. So will not consolidate. Can the company do this? The company can never do this. Understand? IFRS 3 and IFRS 10 says what? If control is there, whether the company is in some different industry, whether it's loss making, etc., XYZ, you have to prepare the consolidated financial statement. So, see here now. IFRS 10 requires all subsidiaries to be consolidated if control exists. Exclusion is not permitted as it could lead to manipulation of financial statements and mispresentation of the group true financial position. So, there are a lot of reasons which I've written, which the company will say that we will not do. So, can I say it is in different activities? Control is temporary, subsidy for repurchase. Then you'll follow IFRS 5. Subsidy is making losses. No, you should consolidate it. Long term restrictions limit the parent ability to run subsidiary. If control is there, consolidate. If control is not there, do not consolidate. You have to see the control point of view also. As mentioned, the important term is was control. Then coming to the next theory topic, investment entities. So now what does this investment entity means? Investment entity means like your mutual funds. These are the like your mutual funds, insurance company, etc. So here, investment entity. A limited exemption is available to the consolidation of certain subsidiaries for investment entities. So see now, first understand what is an investment entity. An entity which obtain funds for from one or more investors for the purpose of providing investors with investment management services. Like they take your money and they invest somewhere and they give you the returns. If they earn 30% return, they'll keep 5 to 6% and the remaining will be given to you. Then commits to those investors that its business purpose is to invest funds solely for return from capital appreciation or investment income or both. Yes or no? They will take the money, either they'll get the dividend or either they'll sell the shares when they have capital appreciation and they'll give the amount. Then next one, measure and evaluate the performance of substantially all of its investment on a fair value basis. That means whatever investment they have done, this will be measured on fair value basis. Then we say it's an investment entity. Now, an investment entity would typically have some or all of the following characteristics. So, more than one investment will be there, more than one investor will be there. Investors who are not related party, the investors will not be related party. Ownership interest in the form of equity or similar interest. Now, the important point here is what these 3 points. Investment entity must not consolidate its subsidiary or apply IFRS 3. If an investment entity is there, this investment entity will have what? Subsidiary. They should not prepare consolidated books. Instead, apply IFRS 9 and measure those instruments at fair value through P&L. If investment entity has a subsidiary whose main business activity is providing services to the investment entity, the subsidiary is consolidated as normal. So, if this is an investment entity, my subsidiary is also an investment entity, then no need to prepare consolidated financial statement. But I say investment entity and the subsidiary which I have, this subsidiary is providing services to this investment entity, then consolidation is required. Then consolidation is required. Understand? Exception not applied to a parent of an investment entity unless parent itself is the investment entity. That means parent company should be an investment entity to use this, which in the exemption which is available to not provide consolidated financial statements. So with this, these are clear. So this was the SBR part, the theory part, which frequently comes in your exam. Now, chalo, let us start with the calculation part and discuss. So now coming to the first calculation for statement of financial position. So consolidate statement of financial position, what should we do, sir? We add the assets and liabilities of the company. We remove the investment in the subsidiary company value when we do consolidation, and we remove the equity part of the subsidiary company. But post acquisition profits, post acquisition revaluation surplus will be included. So share capital of the group, which always equal to the share capital of P only, and retain earnings will include what? Profit earned by group That is historic profit of P plus P's shares of post acquisition profit. So this is a basic example which I've given. How do we do consolidation? We remove this part and we remove this equity part, share capital. We remove so that we get the balance right. Then what is the journal entry on the day one, sir? Asset is coming in. So normally what is the entry the company will pass first? Debit, credit, debit, investment, credit, cash is going out, or bank or any other thing. Now this investment we will remove and we will bring in what? Investment we remove, we bring in assets, we bring in liability, we remove investment, and debit or credit will have goodwill. If it's on the debit side, it's a goodwill, so you'll show. If it's on the credit side, it's a bargain gain or loss. You'll show this. It's a gain for you. You will show this in your P&L as an income. If now in sometimes NCA will also be there, so you should record the NCA also. So now coming to the first calculation, cost of investment. So when P acquires S, the following considerations are paid. Either cash consideration, deferred consideration, share consideration, contingent consideration, fixed asset consideration, and replacement share-based scheme. So now cash consideration, debit investment, credit shares, no issues in that. Share exchange, what's up? Debit investment, credit share capital, share premium. So whenever you do, please read the question carefully. Whether if a parent company is acquiring a subsidiary company and the parent company has done the adjustment for share exchange, whether they have increased the share capital and share premium. See, when coming to your SBR, your adjustments regarding your consolidation will be the basic of FR and FA only. The examiner will not ask you out of the box. In theory, they will ask the SBR part. So it's important that you know the basic. If you know the basic, all the adjustments will be easy. So if they have not done, please go and increase the share capital and share premium. So sir, how do we calculate the value of investment? So you take the share capital of S company, you divide the face value, you multiply the percentage acquired into exchange ratio. If you multiply this, this will give you the number of shares given by the P company. So the number of shares, if I say 20,000, 20,000 into $1 is the face value, this. And I say that the total value is 40,000. So that means 20,000 is share capital, 20,000 is share premium. So what will you do? You'll multiply into the fair value of P company share price. So we have taken an example here, 82 by 5 into 2, 64,000. Then out of the 64,000, how many shares are given? 32,000 shares are given. Face value is $1. So 32,000, 32,000. You will increase the share capital, share premium, parent company, not subsidiary company. Then deferred consideration. So deferred consideration means what? The company is saying, Reliance is saying to Jio that in future we will pay you because today amount is not there. But can I say the amount will be fixed today only? Amount will be fixed only. The date will be in future. The date which is decided to pay will be in future. But we know that we will pay. Is this based on any condition? There is no condition here. It's an unconditional payment. So we record it at a present value. So debit investment credit deferred consideration. One, please see whether the parent company has recorded this deferred consideration in case of balance sheet. If they have not recorded, please do the adjustment in your balance sheet. It will have 1 marks. Then can I say over the period there will be finance cost. So debit finance cost and credit deferred consideration be increased. Now this finance cost will be given to whom? This finance cost only belongs to parent company. So it will be a expense for which company? Parent company. If you're preparing your balance sheet, where do you adjust? Retained earnings. Whenever the profit or loss takes a hit of parent company, you adjust in retained earnings in case of balance sheet. If it's for subsidiary company, you do the adjustment in step number 2, your net asset. We'll do that. So every year unwinding of discount should be done. The impact of finance cost will be adjusted to the profit or loss. That is consolidated retained earnings. In your P&L, where will you take this? P&L financing category. It should be shown under liability side of the consolidated financial statement. That is parents SOFP. Then coming to contingent considerations. So what does contingent consideration mean? Same. A payment that is done in future, but here the payment depends on some future event, future performance, etc. So it's a conditional promise to pay cash. So debit investment credit contingent consideration. Will you record this by discounting it? No. We will follow the principle of IFRS 13 fair value. So see, contingent liability is different, contingent consideration is different. So avoid mistake in this. Contingent consideration should be recorded at fair value on the date of acquisition. Yes, sir. Subsequent changes at the reporting date are adjusted in the parent's SOPL and in the consolidated financial position in retained earnings. Because this difference will only be allocated to parent, not to NCA. It belongs to the parent company. So if it's a contingent consideration is coming down, sir, it is a profit for you because it's a liability. If it is increasing, it's a loss for you. Then fixed asset consideration, that means a parent company is giving some fixed asset. In that case, what? Debit investment, credit asset. Investment you will record at fair value, asset will be recorded carrying amount, whatever is the difference will be gain or loss. This is done to everyone. I have not seen this tested in one of the past paper 2011 or 9, only once it came. Now coming to replacement share based scheme. Replacement share based scheme, this means what? So understand everyone, this is a parent company, this is a subsidiary company. Now this subsidiary company has given ESOPs to its employees. And ESOP treatment where we have covered, sir? IFRS 2 share based payment. Share based payment, IFRS 2 we have covered. Now what will happen? I say that ESOP had a vesting period of 4 years. So if it's 4 years, can I say it was given on 2000x1? So end will be what? 2000x4. Now parent company acquired the subsidiary company on 1st Jan 2000x3. 1st Jan 2003. So can I say 2 years are completed? The employees have worked for 2 years. So subsidiary company would have recorded this as an expense for 2 years. Now what will happen? This subsidiary company have to pay this ESOP to the employees. But parent company acquired 70% of subsidiary. Parent company is saying what? Parent company is saying that this ESOP which you had to give, no, we will issue. The ESOP which the employees had to receive, the shares were regarding which company? Subsidiary. Now Reliance company will say to Geo company employees that you will be getting Reliance shares now for the work which you have done. In that case, the fair value, I say that the fair value of the ESOP is 10 lakh rupees for 4 years. In that case, what should Reliance do? Now, whatever is this is for 4 years. So can I say for each year it will be 2,50,000, 2,50,000? So for this first two periods, can I say, did Reliance take the benefit or Geo? Geo took the benefit, but Reliance is paying. Then this 2,50,000 plus 2,50,000 will become what, sir? Will become your cost of investment. Will become what? Cost of investment. So pre-acquisition expenses will be treated as an investment. The post-acquisition, whatever is will be treated as a normal expense by parent company, as a normal expense. So see here now, acquirer agrees to replace an existing share-based payment award that has already been issued to the employees of an acquiring. The fair value of the replacement share award that relates to the pre-acquisition period forms part of the consideration paid to seller for the goodwill calculation. The fair value that relates to the post-acquisition period is recognized as a staff cost as per IFRS 2 normal. I hope everyone have understood this part also. Then coming to the next part, sir. Sir, any acquisition cost, what should we do, sir? Any acquisition costs will be taken to P&L, like some legal cost, etc. If you're preparing P&L, it will go to operating expense. If you're preparing balance sheet, it will reduce the group retained earnings of the parent company. An important point, all assets and liabilities of the acquiring company are acquired at fair value. So every time it should be taken at fair value. And frequently repeated adjustment is what? Fair value adjustment. So now see here everyone, the steps which you have to follow. See in your SBR exam, you need not do all these steps. But to understand how consolidation is done, you should know these steps. So the first step is what? Group structure, sir. Group structure. In group structure, what we see, what is the percentage you have acquired? So that this will help in the step number 5, whether how much should be allocated to NCA, how much should be allocated to parent. Then, sir, uh, then the date when the parent company was acquired, the reporting date, the balance sheet, the date of acquisition, everything you see. Then you do the step number 2. Is why do we do step number 2? We do this step number 2 calculate the post acquisition profits. We do this to calculate what? Post acquisition profit. So we write down share capital, share premium, retained earnings, revaluation surplus at the date of acquisition. So whatever is the difference will be what are post acquisition. This will be given to parent and NCA. Now, in your exam, what will happen? In your exam, you need not prepare this step 2, but sometimes the share capital, share premium will be given. You have to take these values and you have to calculate the post acquisition profits. Whenever you prepare a balance sheet, if a question one regarding your consolidation comes regarding your balance sheet, please calculate the post acquisition profits. For sure, adjustment will be there. 100% adjustment will be there. Without this, the examiner cannot test for give the question for 14 marks. For sure, for 2 to 3 marks, this adjustment will be there. Just take the values on the what is the retained earnings on the date of acquisition, what is the share capital, share premium, and revaluation surplus to calculate the post acquisition profit. And understand, for this attempt, coming attempts, balance sheet, the chances of balance sheet is very less. P&L and cash flow is very high because the format has been changed for P&L also and for the cash flow also. So then you will do some fair value adjustments, etc. We will see that what is that. So now chalo. So with this, I hope, why do we do this, sir? We do this to calculate the post acquisition profits. Then what is the next step number? So the step number is what? Goodwill calculation. Then after this we have NCA calculation. Then we have retained earning. So now let me do the next important part, the fair value thing, which is very important for FA, FR as well as SBR. This is tested in FA only, but again it carry forward to FR as well as in SBR. You will have for sure. If you get a balance sheet question, for sure adjustment will be there for 1 or 2 months. So note, all assets and liabilities of the acquiring company are to be taken at the fair value on the date of acquisition. So sometimes what will happen, sometimes fair value adjustment is required as it would have not been adjusted on the date of acquisition and reporting it. Sometimes the company will forget to record it, so we have to do it. So see here now, asset is recorded at the carrying amount of 1000, but fair value is 1300. So 300 should be adjusted. Yes, sir. So on reporting date, what we do on your balance date of acquisition, we increase the fair value of the asset. Then date of acquisition, the asset value, we increase it. On reporting date, can I say on reporting date also we'll take it 300? But can I say this is a depreciating asset, so depreciation will be that. So we'll take a depreciation of extra 50 and we will adjust this. The closing balance will be how much? 250. So please do the adjustment in balance sheet also in your financial position, because if they have not recorded, that means the examiner is giving you marks to take this into post acquisition calculation plus to do the adjustment in your balance sheet. You have to do vertically, understand? Then sir, non depreciating asset, 300 you will record, no need to depreciate it. So sir, this 50 is an expense. Can I say this 50 is an expense of which company? This 50 is an expense for subsidiary company. So this expense will be allocated to parent and NCM. Automatically, this will be adjusted in post acquisition profits which you calculate. Then, sir, if it's the asset is recorded at a carrying amount of 1000, but the fair value is 700, it's reverse. So it's 700 means what will happen? Can I say 700 means what will happen? The fair value will reduce here. Here the fair value will increase here. I'm not. It's not a minus sign. It's a positive sign. Here it is negative, sir. So 300 negative, 300 negative. But can I say on this 300 we should not charge depreciation, but the subsidiary company has charged depreciation. So we added back again 50. So the net impact that will be taken is how much? 250 in your balance sheet. In the both the cases 250 only, but what is the difference here? Here it's a positive 50, there it's a negative 50. It's a saving here, there is an additional expense there. So now for non-depreciating asset, no such issues, minus minus. Then coming to the fair value adjustment for inventory. This comes for FA and FR, but in SBR also, which a bad day, it can come and students will say, sir, out of the box. Nothing was out of the box. A concept is given, you have to know that. Fair value adjustment for inventory. Subsidiary will measure inventory at lower of cost or NR. Yes or no? If it's a subsidiary company, they measure inventory at IS2 as per cost or NRV. Now you everyone knows that NRV is what's entity specific. When we use IFRS 3, IFRS 13, I mentioned entity restriction will not be considered. Entity restriction means what? Today I purchased a car. I want to calculate the fair value. I say that this car I will be only using for my business purpose. But if I use this car for renting purpose or as a taxi, my fair value will be more. In that case, as per normal market conditions, you will consider it. What you can do. So here, see now, sir. If fair value on the acquisition is high, then it should be adjusted on the date of acquisition. So I have taken example. What is the maximum the examiner can ask you? See, cost is this, fair value 120. So on the date of acquisition, we adjust 120, and reporting date also we adjust 120 because the inventory is full. The inventory has not been sold. The inventory has not been sold by the company. Understand that. Then on the date of acquisition 20, but I say on the reporting date the inventory has been sold. If the inventory has been sold, what we do? We add 20 and again we reduce 20. So the net impact is what? 0. And this 20 will be an additional expense for subsidiary company. So the next one, 20 company and only half of the inventory has been sold. That means remaining is 10. So out of 20, sir, half is sold. So remaining will be 10 here. And this you have to do the adjustment in your balance sheet again. So reporting date will include the fair value of the inventory not sold. Understand that. So with this, I hope the fair value adjustment is clear to everyone. Then recognition exceptions that the subsidiary company will not record, we have to record. We have just seen, like intangible assets, we have to record it. Yes or no? In like your brand, customer list, etc. But as per IFRS 3, this should be recorded if it is identifiable. Contingent liability also we have done, it is disclosed, but we have to record this as a provision. Then research cost. So research cost normally we take into P&L. The subsidiary company will normally record research cost into P&L. But when they do consolidation, they should take this as a asset if this has some value for the acquirer. The acquirer will say that okay, this research cost is providing a benefit to us, so we will take into consideration. If not, we will ignore it. Then next one, step number 3 is a goodwill calculation, a very important thing. So in goodwill calculation, there are two methods: proportionate net asset method and full goodwill method. So proportionate net asset method means, sir, the goodwill which we calculate will only belong to parent. A lot of time theory question comes regarding this. Explain the difference. If this question comes, you are very lucky. So proportionate net asset method, and a lot of times the question comes how goodwill is calculated. The question will say discuss how goodwill is calculated. You need not do the calculation. If numbers are not given, then just write down this in a story form. We'll take the purchase consideration, then we'll do what, we will take the part of the NCA. We'll take the part of the NCA. Now how will calculate the part of the NCA? In the step number 2, we will have this net asset, no, this figure net asset, this figure net, we will take this into and we'll multiply with the percentage. Then less fair value of the net asset on the date of acquisition, you will take, you will get. If it's a positive number, it's a goodwill. If it's a negative, it is a gain on bargain purchase. If it's a gain on bargain purchase, it will hit your retained earnings and P&L. It will not hit your balance sheet regarding non-current asset part. If it's a goodwill, it will take a hit. Less impairment. Now this impairment will only belong to parent better. And this is the thing we have. Then full goodwill method. In full goodwill method, what will happen, sir? So purchase consideration, cost of investment, add what's a fair value of the NCA on the date of acquisition, less what. Now here this you should take fair value. Here you should not take the net asset calculation. This net asset will not take into consideration the market factors. Understand that. Less fair value of the net asset on the date of acquisition. A question comes in your mind, sir, why are we adding this back? Because the fair value which you're taking, no, this is 100% better, but you have only acquired 70%. So to do the comparison like with like, you add back 30%, so the comparison becomes like with like. Goodwill gain on bargain impairment. This impairment will be given to parent and NCI, both of them. Excuse me. Then goodwill act reporting date, you will get this value. Then note, if goodwill is positive, it should be treated as a non-current asset. If goodwill is negative, it is treated as a gain and included in the consolidated retained earnings. In your P&L, normal income recorded in a P&L. Under which category? Operating category. Fair value of NCA on date of acquisition, sir. Sometimes the fair value will not be given. We have seen this in your SBR also. You will take the number of shares which NCA has and you will take the share price of subsidiary company, not parent company. Understand that. Then what? Impairment of goodwill. So proportionate method, sir, it will only be given to parent. Sir, in full goodwill method, it will be given to NCA and parent, both of them. Now, a important question that comes in your exam. Sometimes what will happen? Sometimes what they will give you, no, they will give you the carrying amount of the assets and they will give you the RA. The goodwill impairment will not be given, but you have to calculate the goodwill impairment. So what do? You normally, you take the carrying amount of the asset, you'll do plus goodwill. You'll do plus goodwill. Let's take it as 100 plus 40, it's 140, and your recoverable amount is 120. So my impairment is how much, sir? Your impairment is how much? It's 20. So this 20 will be given to parent and NCI. But the other way around, I say sometimes what will happen, the carrying amount of the asset you take, this goodwill which you have done, no, this is a fair value method, full goodwill method. Now, current asset, now you take the goodwill. Now, this goodwill which you have calculated is based on proportionate method. Is based on what? Proportionate method. What will you do? 100. Now, if I say the goodwill is 80, so can I say this goodwill, current asset is 100, goodwill is 80, then RA is that. Can I say RA will be what? 100 percentage. Can I say this is also 100 percentage, this is 100%, but this is only 80 percentage better. So you have to gross it up. You have to gross it up. So what we'll do, 80 divided by 100 into 80 percentage. If you do, you will get this. Sorry, ulta I have written, no? Divided by 80, sorry, my bad. Divided by 80. It is 100. You're getting back as 100. Now we will say what, this is what 100. So 100 plus 100, you compare this what with your RA. Your RA is, let's take here, your RA is what 120. So how much is your impairment, sir? Impairment is 80. Now this 80 impairment, will this be given to parent? Yes, sir. So what is the parent perf? The full 80 will not be given. Only 80 percentage will be given of this 64. Understand that. Even though it's what proposed method, but to compare, sometimes the examiner will give you the RA and you have to calculate the impairment. The impairment will not be given directly. This was tested in previous papers a lot of time, but now the coming 3 to 4 attempts I have not seen this type of question, but it comes, you should be able to do in your exam. Then chalo, next step number 4, so NCA calculation proposed in net asset method, sir. We take fair value of the net asset on the date of acquisition into NCA percentage, then NCA share of post acquisition reserves. In proposed method, there is no impairment that should be given. Full goodwill method, what we do, fair value of the NCA we take given in the question. If it's not given, take the number of shares into the share price, add NCA share of post acquisition reserve, add NCA share of impairment loss also. So we'll get the NCA at what? NCA at reporting date. Reporting date. Step 5 is what, sir? Step 5 is a group retained earnings, a very important thing. So group retained earnings, sir, we'll write down P's retained earnings 100%. Then we write down P's post acquisition profits. Then we reduce the impairment share. Then now understand, whenever the parent company's profit is affected, you will adjust in retained earnings. Whenever subsidiary profit is affected, you adjust in post acquisition profits under your net asset. So less deferred consideration, contingent consideration, any decrease or increase you will record here. Then other things we will discuss now. URP, other cases. Understood the 5 steps, everyone? Yes or no?
Yes, sir.
I hope it's a very good revision. I'm doing each and everything in detail and I'm mentioning what are the adjustments that can come. I can't do questions, etc. It's better that we go with the revision flow and mention what are the mistakes you should avoid in the exam. So now coming to intra-group sales. If this intra-group sales is that, this is frequently repeated topic in your PNL question. And this certain for sure, one set will have PNL, one set will have cash flow. Balance sheet chances are very less. So if intra-group sale is there, sir. So P company is selling to S company. So P company will record in its book as a sale. S company will record it as a purchase. Now we are talking from the point of view of only balance sheet, not P&L. When we come to P&L, we'll discuss that again. What are the adjustments that should be done? So parent company, it is 1,000. So subsidiary company is 1,500. They are sold. So can I say parent company has made a profit of 500? Now, this subsidiary company has not yet sold these goods to anyone. If the subsidiary company has not yet sold these goods to anyone, then in this case, it will become what, this 500 will be your URP, unrealized profit. So, but when we prepare consolidation, can I say I have to remove this impact? Because it's a single entity. The company will not sell the goods at a profit to itself only. So the amount of unrealized profit and group inventory in case of parent to, yes, offsetting parent to subsidy should be adjusted in the consolidated statement of financial position. So what we do, sir? Profit, which company has recorded profit? Parent has recorded profit, sir. Which company has recorded more inventory? Subsidiary company. So simple thing we do what, sir? We reduce the group inventory and we reduce and we record this as a decrease in the retained earnings. We reduce the expense, we reduce the profit, we reduce the profit of parent company. So reduce the consolidated retained earnings and group inventory. So everyone knows the markup and margin. If in the question it is mentioned cost plus 50 percentage, it's what markup, understand. If it's mentioned cost plus markup, do not do this silly mistake. Now this URP will be based on what, sir? URP will always be based on the goods which are not sold. If I have given you $1,000 of the goods today, out of that you have sold 600, I will calculate the URP only on 400. Then case 2, subsidiary to parent. So sir, subsidiary is recording a profit and parent is recording more inventory. So the 40, the first thing, sir, URP we calculate 500. This URP will reduce from the group inventory. Now subsidiary company is recording more profit. If subsidiary company is recording more profit, that means post acquisition profits will be affected. So we will go and we will reduce this amount from subsidiaries Subsidiaries retain earnings, that is step number 2. You will reduce this from step number 2. Reduce URP from the net asset at the reporting date, and group inventory, your adjustment is done. So with this, I hope there is no such doubt. Then coming to intra-group sale of non-current asset. If parent company is selling a non-current, so parent is selling to a subsidiary, sir. So if parent is selling to subsidiary, that means what? Parent company recorded a profit, sir. So parent company recorded profit, subsidiary company recorded value of the asset more. So do one thing, sir, reduce the retained earnings of parent company and group non-current asset. Simple. But but if we remove this, can I say subsidiary company recorded excess depreciation? Normal depreciation should be how much? 200,000 divided by 5 years, assuming useful life as 5. So 200. So subsidiary company recorded excess depreciation. But so from the group point of view, there is no concept of excess depreciation, or intra-group item should be eliminated. So see, what should we do here now? So add the excess depreciation, because subsidiary company recorded more depreciation. So expense is more, profit is reduced. Profit is reduced means retained earnings is reduced. So we do what? Add excess depreciation to the net asset of the subsidiary at reporting date. We increase the value of retained earnings at the date, and group non-current asset. Group non-current asset here. Then, sir, next case, subsidy to parent. This I have not seen in your old past papers. This has been tested, but we can't say anything. As mentioned, your adjustments which comes in your SBR are the basic of FA and FR only, nothing new. So see now, but what is the issue that there you adjust vertically, but in your FR you used to prepare step 1, step 2, step 3, step 4. Here also you have to do, but the adjustment should be done vertically. You need not prepare the full consolidation statement. Only a adjustment will be done. So read the question carefully whether the adjustment is done or not. The examiner will mention, okay, this has not been done. You have to do it. So now subsidy to parent, sir. So subsidy to parent, that means who has recorded more profit? Subsidy company recorded more profit of how much? 500. If subsidy company recorded more profit, can I say subsidies retained earnings will reduce and group non-current asset? So how we will reduce subsidiaries group retain earnings? By adjusting in this step number 2. Reduce the URP from the net asset of the subsidiary at the reporting date and from the group non-current asset. Then next one, sir, excess depreciation. Who will record excess depreciation now? Parent company will record excess depreciation. So the excess depreciation, how much, sir? We have to do charge 200, but we are charging 300. So 100 is the excess depreciation. So what we'll do? Parent company recorded more depreciation. Parent company profit is low. Parent company retained earnings is low. We have to increase the parent company's retained earnings. So add the excess depreciation to the consolidated retained earnings and group non-current asset. Group non-current asset. I hope this is clear to everyone. Then intra-group loan. In this intra-group loan, I have never seen an adjustment regarding interest. Never seen an adjustment regarding interest either in FR or SBR. But what will the examiner mostly give? The examiner will say that parent company is a subsidiary. Parent company has given a loan of 10,000 to subsidiary company, and subsidiary company will record as a loan. Parent will record it as a financial asset. It's a financial liability. So intra group items you have to eliminate, remove it. Even though you will not remove it, your balance sheet will tally, but this is wrong. You have to remove it. So intra-group items should be eliminated. So this which I mentioned here, case 1 and case 2, is regarding the interest cost. If they mention in the question, what should we do? So parent company is giving to S company, sir, loan. So parent company will record income, subsidiary company will record expense. So I will remove this income from my retained earnings, and I will reduce. I'll increase the income of subsidiary company because we have to eliminate. And for subsidy to parent, what will happen? Ulta. Subsidy company retained earnings will reduce, parent company retained earnings will increase in step number 5, or working note number 5. Some important notes now. Intra-group receivable payable should be eliminated. Intra-group your loans should also be eliminated, etc. Now sometimes what will happen at the year end, the current account will not agree. That means the current account of parent and subsidiary. So the parent company will say that we have a receivable of 2,000, but the subsidiary company will say that in my books only 1,400. That means what is happening here? Subsidiary company is doing the payment, but parent company did not receive it. We can say this way: subsidy mentioned that we have done 600 of payment, parent company did not receive. So what we normally do, we remove 2,000 from the balance sheet, 1,400 we eliminate it. From receivable you remove 2,000, from payable you remove 1,400. The 600 will be as a cash in transit, you will include in the cash value. or goods can be in transit. So if goods are in transit, in that case what we say, if goods are in transit, if I say the same question, parent company sold goods but subsidiary company did not receive, so subsidiary company payable is not increased. So what will I do? I will remove 2000 from the books, I'll remove 1400, then the 600 I will record in the inventory. Either it will take a hit to inventory or either it will take hit to cash. So we have discussed cash in transit. What we do, we add the cash value. In goods in transit, we increase the value of the inventory here. So now coming to the dividend payment. So for dividend payment, what will happen, sir? Dividend payment by subsidiary company. So whenever dividend is paid by subsidiary company, can I say subsidiaries retained earnings is low? So you will simply do what? Add back dividend payment to net asset at the reporting date. Whatever is the dividend payment, the full amount, you will just go and add to the value of net asset. So parent company will reduce its portion of dividend from the step number 5. Yes. If company has paid a dividend, that means what? I say parent subsidiary company paid a dividend of 1000. Can I say subsidiaries retain earnings is bill low? So you will do what? You will again go and increase the value of retain earnings. If you go and increase the value of retain earnings, your post acquisition profits also will increase. Then post acquisition profits will increase, your NCA value will increase, your parent value will increase. What should you do? You should again go and reduce the parent portion and NCA portion. So see here now, parent company will reduce its portion of dividend from step 5, consolidated retained earnings. Reduce NCA portion of dividend from the NCA calculation. If NCA portion is not yet given, it should be shown as a liability under the consolidated financial statement. This also I'm not seeing such adjustment. If it comes, you should be able to do it. Dividend payment by parent. If parent company is paying dividend, then no treatment is there. No such treatment. So no treatment in the consolidated financial statement. It will be treated under separate financial statements. Now, if the company is acquired between reporting date and then the net asset at the date of acquisition should be time apportioned. If you remember, in our regular classes, I've explained you two cases here now. See here now. I mentioned if it is a mid-year acquisition, what we do. Sir, this is a subsidiary. The subsidiary company profit is how much? The subsidiary company profit is 200. So now if the subsidiary company profit is 200 and I acquire the company on 1st January, can I say out of this 200 profit, 80% or 70% will belong to me? But we say that we acquire the company on 1st July. In that case, can I say this 100 will not belong? Pre-acquisition profits will not belong, only post-acquisition profits. How much is that, sir? 100. So can I say what will be the retained earnings on the debt, sir? 100. So you have to time a portion and time a portion and correctly calculate the retained earnings. So I say the retained earnings you have to correctly calculate. So remember this, a very important point. Then, sir, now starting with the statement of profit and loss. Sir, how should we do statement of profit and loss? What is the standard approach? Group structure, add everything, add income, expense, everything, add it, no issues. Then do the adjustments, remove intra-group item, a lot of things, do the adjustment and show NCA share of profit. Whenever you get question, please do this. 3 to 4 marks will be there for this only. NCA adjustment. So see here now. Parent company, subsidiary company, PNL is there here. So what we normally do, we add each and everything. Yes, sir, we add it. No issue. Then what we do, sir, out of this 1200 profit, can I say some profit belongs to NJ? Now, which profit belongs to NJ? Only subsidiaries profit. So I'll take subsidiaries 600 into 40 percentage. That the 360 belongs to NCI. So 360. Can I say remaining 840 will belong to whom, sir? Parent. So you have to mention this profit attributable to equity NCA and this one and equity owners for total comprehensive income also you should do this. Now understand, whenever your subsidiary company profit is affected, it will affect parent and NCI both. If parent company profit is affected, it will only affect the parent or the owner. So when you do the vertical adjustments, if I say subsidiary profit is affected, so you do the adjustment for parent also, you do the adjustment for NCA also. If I say only parent profit, then what you do? Only for the owner you adjust. Understand that? Equity owns. So see here now, how do we calculate NCA share of portion? You take subsidies profit after tax figure less fair value adjustments you do. Because can I say, because of fair value adjustment, can I say the depreciation is increasing? But now in your class, in your F7, you used to do this one. But now if I say there is a fair value adjustment and the additional depreciation is 100, can I say this 100 additional depreciation belongs to 80 to parent and 20 to NCI bete? 18. So when you do vertical adjustments here, what should you do? When you do this, you should show here what? Minus 80 for parent, minus 20 for NCI. And above, you should say that it is a expense of 100 in total. You'll increase your cost of goods sold. You'll see the question whether it's recording cost of goods sold, administrative expense, etc. etc. You should do this one. Frequently repeated adjustment in your P&L part. Then, sir, impairment. Can I say, if I say impairment is there, and that impairment is for full goodwill method? Can I say full goodwill method? What should we do? You will increase the cost of sales, saying that sir 100 is my now, out of this 80 will be given to parent, NCI will be given 20. Allocate it. If I say it is a proportionate method, you will take 80 here and you will do what? Only 80 you reduce. Simple. No other adjustment. Then sir, see here now, any URP, you will take it and then you will get adjusted profit. Then you will apply the NCA percentage. NCA. Either you can do your F7 method also, no issues, but be little bit quick, because if you do the total calculation, it will consume a time. So it is better to understand the logic and do it. So now see, fair value adjustments are excess depreciation, cost of goods sold will increase. Add the because if you increase the cost of goods sold, profit will come down automatically. So this 10 will be taken care in your balance sheet under net asset. This 10 is added to the cost of goods sold and reduced from the subsidies profit after tax for calculation of NCI. So this 10 will affect parent as well as NCI in your vertical adjustment when you do for draft consolidated P&L. So saving in depreciation, sir. Saving in depreciation, what should we do, sir? Decrease the cost of goods sold. You will decrease. And can I say this decrease means it's a profit for whom? It's a profit for NC and parent. So reduce the consolidated cost of goods sold and add 2s profit after tax for NCA share of calculation. So this 10 will be a positive number. Instead of reducing it, add it. That 8 will belong to parent, 2 will belong to NCA. So then fair value of inventory. Whatever is the value of the inventory which you have sold. If I mention 20 is the fair value increase, the inventory we have fully sold. So this 20 will 20 will affect your parent also and NCA calculation both. If I say the company have not yet sold any goods, not yet sold any inventory, then no adjustment only in P&L. Understand? Increase the consolidated cost of goods sold by the fair value of the amount of the inventory sold and decrease the subsidies profit for the NCA share of profit calculation. Here, when you do this, chalo now. Intra-group trading, sir. Frequently repeated adjustment. In our regular classes, we have done more than 10 to 12 P&L question draft one. And we have seen in each and every question this adjustment was there. Either it could be an exam question, either it could be some other past paper also. So see now, parent company selling to subsidiary company. So here you have to do two things. So parent company will record revenue, subsidiary company will record purchase. So first thing is what? Reduce the consolidated revenue and cost of goods sold by transaction amount. Whatever is the transaction amount. Can I say the transaction amount is better 500? You'll reduce it. Reduce revenue and cost of goods sold. Then sir, what we do? Can I say URP will be there? Now, what is the URP? Can I say URP will be calculated on what, sir? URP will be calculated on the goods which are not sold. So the full goods is with the company. So that the URP is how much, sir? The URP is 300 here. Now, which company has recorded the URP? Profit. Which company recorded profit? Parent company has recorded the profit. So, which parent company has recorded the profit? Will it affect NCI? No, Baba. It will only affect the owner. So, what will you do in your adjustment? We will increase the cost of goods sold. Yes or no? URP will be added to cost of goods sold, and whatever is this, you will do the adjustment for what? Parent also. You will adjust this for parent also. Only parent, not NCI. Because in your draft P&L, what will the examiner do? The examiner will already give you parent profit is how much, NCA profit how much. But in this, they would have not done this adjustment. You have to do it. Second case, subsidiary to parent company, sir. Subsidiary selling to parent, sir. Then what will happen, sir? You will reduce the consolidated revenue and cost of goods sold by the transaction number. Now the URP should be allocated to parent and NCI. Out of 100, 80 will be reduced and 20 will be reduced for NCI. Vertical adjustment. I hope there should be no doubts in this one. See, URP will be deducted from the profit after tax for NCI calculation. URP will be added to cost of goods sold. Simple. Then coming to non-current assets, the sale of non-current assets. Same repeated point. Parent company selling to subsidiary company. Parent company recorded 500 rupees profit. So we decrease the profit. To decrease the profit, what we do? We will increase the cost of goods sold. But sir, the next one. Can I say which company has recorded the profit here? Parent company. So it will only affect the parent part. The next one. Now, which company has recorded excess depreciation? Subsidiary company. So, excess depreciation is, let's say, 100. So, what will the subsidiary company do, sir? We have to increase the profit. How we will increase the profit? By reducing the cost of goods sold. Excess depreciation will be deducted from the cost of goods sold, which is recorded by subsidiary. If subsidiary profit is taking a hit, can I say it will hit what? Parent and NCA again. So, what we do? This excess depreciation, we will add the profits to NCI and parent will increase 80 and 20 here. And in the cost of goods sold, we will reduce the cost of goods sold by 100. So automatically the profit will increase here. So excess depreciation will be added to the profit after tax for calculation of NCA share of profit. Then case 2, sir, subsidiary to parent. Now you only say subsidiary has recorded a profit of how much, sir? 500. Parent recorded excess depreciation. So now subsidiary recorded more profit. We have to reduce the profit. How we will reduce the profit, sir? We will increase the cost of goods sold. When you increase this cost of goods sold by 500, can I say here will you reduce the profit of parent 400 and 100 you will reduce for parent and NC. Now, which company is recorded? Now, did we do the first adjustment? Yes, sir. Then decrease the profit. URP will be reduced from the subsidy profit after tax for NCA calculation we have done. Then which company has recorded excess depreciation? So parent company has recorded excess depreciation. So what we do to increase the profit, we reduce the cost of goods sold. To reduce the increase the profit, we reduce cost of goods sold. In that case, what will happen, sir? Only the excess depreciation will be adjusted to parent year. Only to parent year. Understand? You will increase the value. I hope everyone you will increase here and you will reduce the cost of goods sold. I hope this is clear to everyone. There is no doubts in this. Then intra-group loan, what did I mention for intra-group loan? You will eliminate it. One company will record interest income, interest expense, interest income, you will eliminate it. Parent will record income, subsidiary will record expense, eliminate. Even though you will not eliminate, your P&L will be right, your answer will be right. One side income, one side expense. So nullify effect. If you will not record also, the value will be same. So you have to remove it. If not, examiner will reduce your marks. Subsidiary will record income, parent will record what, sir? Your expense. So if there is any management charge, like intra-group items, some management charges are that also should be eliminated. One company expense, one company income, that also should be eliminated. Now coming to dividend. Now can I say subsidiary company is paying a dividend to parent? Can I say parent company will record it under investing category? So remove this. Reduce the parent share of dividend received from subsidiary from the consolidated finance income. It's not finance income, it's investing. It will be recorded under investing category. You have to remove that. Then, sir, impairment of goodwill. If there is an impairment for goodwill, already I've discussed about how will you do the adjustment vertical. So, impairment, if it's a full goodwill method, what we do, sir? Give to NC and parent both. If it's a proportional method, only to parent. Now, where we will adjust this, sir? Impairment of goodwill will be added to the consolidated operating expense operating category unless specifically mentioned in the question. We have seen a lot of past papers where they have mentioned that the adjustment should be done in cost of sales. Then do that, no issue. Any gain on bargain purchase is recognized in the operating category of profit and loss immediately, regardless of how NCI is measured at date of acquisition. So the gain on the bargain purchase will be recorded in operating category, and this will only be allocated to parent. This will never be allocated to subsidiary NCI. It will only be allocated to parent, whichever method you follow. Sir, in goodwill, when impairment is there, we have to see and then allocate the impairment. But here, if it's gain on bargain purchase, you will never see what? You will never see which method you follow. Directly allocate the gain on bargain purchase to parent company only. No need to do further adjustments. Deferred consideration, sir. This also, deferred consideration. For which company this is an expense? Can I say deferred consideration? It will increase your finance cost. Parent company, only it will be allocated to parent here. So it will be shown on financing cap. Contingent consideration also, it will be shown in operating category. Contingent consideration will be shown in operating category. Understand that. And this will also affect only parent profit that is attributable. Sir, acquisition cost will be shown in operating category. This also will take a effect for parent company only, not for NCM. If the company is acquired between the reporting date, then consolidated statement of profit and loss should be time apportioned. That means parent company, subsidiary company. Subsidiary company was acquired after 6 months. So each and everything, revenue, income, expenses, all this should be time apportioned by 6 by 12, 6 by 12, 6 by 12. Everything. With this, we have completed the P&L part also. I hope this is clear to everyone. There is no doubts in the balance sheet and P&L. Each and every adjustment I have mentioned, how will you show it in your balance sheet or P&L? Now coming to associate, sir. In case of associate, what do we follow, sir? Associate means what, sir? An associate is an entity over which an entity has significant influence. Write down this, get 1 marks. So what is significant influence? Significant influence means the power to participate in financing and operating policy. Whenever the financing and operating policies are made, you can take a part in that. You can give your advice. Whatever you say, they will not follow. You can only give your advice. So that means, but it is not a control or joint control. What is joint control? We'll come to this. So significant influence is assumed with a shareholding of how much? 20% to 50%. Now, significant influence is usually evidenced by one or more of the following. See now, presentation on the board of representation on the board of directors or equivalent governing body, participation in policy making process, material transaction between the investors and investee, interchange of managerial person, we are changing the management, provision of essential technical information, some technical information I'm providing. In your exam, this will not be tested in detail. The question could be regarding this one, first point and your second point. So representation on the board of directors, you have to see out of 10 directors, you're only able to appoint 3. That means control is not there, significant influence is there. Understand that. So a lot of time a question comes whether if you're not able to do consolidation, what should we do? You should do IAS 28. You should follow what? IAS 28. IAS 28 says what, sir? Equity accounting. Please write down this. Whenever any question comes, please write down what does investor. When will you say associate accounting? We will follow associate accounting IAS 28 when there is significant influence over the entity. So IAS 28 says that we should not do consolidation. We should follow equity accounting. Equity accounting says what? To do one line adjustment. One line adjustment. So that is what is the one line adjustment? Carrying amount of the investment, carrying amount of the associate in your balance sheet, in your P&L, it is what? Share of profit of associate. So see here, how do we calculate? Equity method. Investment in associate line within non-current asset, which includes the cost of the investment plus this one. Write down this also carries 1 marks most of the time. In P&L, what we take is a share of profit of associate, which includes the group share of any associate. You'll record the share of profit of associate which belongs to the group company. So now, sir, how do we calculate CNO? Investment in associate. Investment in associate, I mentioned how this will be tested. Sometimes what? The associate company will pay you dividend. The company would have recorded under investing category full amount of dividend. Remove this dividend, record what? Share of profit of associate. Do this calculation working note and include it. Simple. And in this full amount will be allocated to parent only, not NCA. If subsidiary is there and associate is there in a question, we have done this question in a class also, in regular class. Now chalo, investment in associate at cost. Sir, add what? Post acquisition profit earned by associate. Yes or no? Today I've invested 10,000 in the first year. What is my income? I will add it. Less impairment of investment. Whatever is the impairment, you will reduce it. So less dividend from associate. Whatever is the dividend you receive, reduce it. You ready? Because you are realizing it. Year above, you have included profit of 10,000. From this 1,000 only, you will receive the dividend. No. So remove 300 dividend which you have received. So ultimately, how much will be the amount? 700. Then, sir, URP. Let us see UR. In case of investment in associate, URP will be what? Parent to associate only will come here. Then less share of excess depreciation. If there is any excess depreciation, you will include it. So what is the journal entry? Debit investment credit cash or bank. Debit investment credit P&L or retain earnings. Now this is taking a hit for parent company's profit. If parent company's profits are taking a hit, in the P&L you record one single line item. But in balance sheet, what should you do? In the balance sheet, you should include in the retain earnings also. In the balance sheet, you will record in the investment value also, carrying amount of the associate, as well as in group retain earnings also the adjustment should be done, because the profit of the parent should be carried forward to the retain earnings. So if the dividend, if there is a this one, if impairment loss, we will say it's a loss and we will reduce the investment value. And once you receive what the dividend, you reduce the value of investment and you say cash is coming in. This will not affect your consolidated retain earnings, understand? In P&L, how do we record? Share of associate profit. So you write on consolidated statement of profit and loss. You take this all, then whatever is the associate profit, you take this associate profit after tax into the percentage you record, less the amount of URP. This will be from A to P sale, and less impairment of investment in associate, the amount, less share of excess depreciation. You should take the share, you have to multiply the percentage, then you will get what? Share of associate profit in consolidated P&L. Now see intra-group trades, sir. How we will do? Case one: parent is selling to whom? Parent is selling to associate. If parent is selling to associate, can I say parent recorded more profit? So you will reduce. How will you reduce? Reduce in the case of P&L. In case of P&L, will increase the cost of goods sold, sir, and this will affect your parent company on. Sir, in balance sheet, what we will do? In balance sheet, you will reduce the group retain earnings. Step number 5. Sir, now we should associate has the inventory. Now you only say, are we consolidating the inventory of associate? We are not doing the associate inventory. We are not recording the value of inventory in associate inventory. We are not recording in the books. So what we can do? We can reduce the investment in associate value, because associate inventory is not recorded in the balance sheet. But what is recorded? Investment in associate. We reduce that. So what? Take the URP amount and then multiply the percentage. This is very important. It is very important that you apply the percentage. Sir, case 2, associate to parent, sir. In that case, what will happen, sir? Debit share of, what will happen? Associate is selling. So that means we will debit the share of associate profit. That means we will do what? We will reduce the profit of associate and we will reduce the inventory. Why? Because parent company has the inventory. So we will reduce it, and you will reduce from the group retain earning also. Why? Because if subsidiary associate profit was more, parent company's retain earnings also will include more profit. So again, you have to reduce from that, and you will reduce from the inventory of the balance. From the balance sheet, you will remove the excess inventory. So with this, this is done. So again, I have written what are the additional adjustments we do here, each and everything. Parent of share of associate profit, less impairment of associate, less URP of both the cases, because that URP adjustment is not done in this. If the URP adjustment is done in that, then no case to again repeat here. Group return. So then step number 6, we do what? We calculate this investment associate. Already discussed with you. Any doubts still here? Anyone? No? Okay, others?
No, sir.
No doubts. Okay, okay. Atish, Janvi, Sahil.
No, sir.
No doubts. Okay, better. So with this, till here we have done the FR part, FA part. Now let us do one thing. Let us take a 10 minutes break and then come and do the additional thing which is there for your SBR and foreign subsidiary, cash flow, everything we will do after that. So now the time is 10:53. Everyone be back by 11:03. Take a break. Chalo, 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 come back, everyone. Yes or no in the chat box. Yes, chalo. Yes, chalo. See, we can't waste even a single minute of time. So in our regular classes, we do time pass also and learn. But here, it's a revision. So even a single minute, I'll not waste because time is very important. So chalo, let us start. Now starting with the next important topic for your SBR. Now the next topic which we'll be learning, the step acquisition and step disposal, are very important, and this can come in your exam for for 5 to 6 marks. Sometimes a theory question will come, how the adjustment should be treated or what should be done, etc. XYZ. Now chalo, step acquisition. So step acquisition basically means what today? Today the company has 10 percentage. They have acquired additional 50%. So it becomes 60. So can I say control is there? Yes, sir. Then the company has today 20 percentage. They have acquired 40 percentage. Then control came, sir. Then the company has 60 percentage. They acquired additional 10 percentage. It becomes a. Can I say here only control is there? Here it will be treated as per IFRS 9. Then we got control. So control. Here IAS 28. So these are the step acquisition means what the company will slowly acquire shares of the other company. So in that case, we have to see whether we have control or not. Once we have control, consolidation. Simple. So now let us see. Entity acquires shares of another entity in stages, multiple acquisition, which eventually results in obtaining control. Slowly, you'll get the control. Now see what are the cases. Control is retained. That means from 70 to 80%. That means additional. So subsidiary to subsidiaries. The company already had control, but further stakeholding has been increased here. Significant influence is achieved. So significant influence means what, sir? From investment to associate. We are traveling from subsidiary to subsidiary, from investment to associate. The next one. In this case, control is achieved. In what gets a investment to subsidiary 10% to 60. Associate to subsidiary. What do we do? 35% to 70% we are moving. The frequently repeated topic is which one in your exam? For theory, most of the time I've seen for theory this comes. For calculation also, as well as this also. This one very rare. These are the two important things. Three adjustments. Now see here now. Now when will we calculate goodwill? We only calculate goodwill when we have control. Goodwill arises only when control is achieved. This is on the acquisition date when the control is achieved in step acquisition. When control is achieved. Can I say here is control achieved or do we have control already? We already have control here. Understand that. Excuse me. If a company already has a control, will the company again calculate the goodwill? No. Write down this. Write down. You'll be getting marks. Then investment to subsidiary, associate to subsidiary. Can I say in this next case, can I say what we will have? Control is achieved. In this case, we will calculate the what we will calculate? Goodwill. So in this first case, goodwill is not calculated. In the second case, goodwill is calculated. Now, next one. Just better. Now, chalo, first let us see from subsidiary to subsidiary, which is very important for theory. Subsidiary to subsidiary, increasing in controlling interest. Once control has been obtained, any further acquisition of shares are accounted within equity and goodwill is not recalculated. 1 marks. We have done a lot of questions also from the exam, your past papers as well as your basic questions also, and I mentioned you have to write down this point. NCI decreases, no goodwill, so you have to write down any further adjustment will be done in equity and goodwill will not be recalculated. So see the treatment. Decrease non-controlling interest in the consolidated financial statement because the non-controlling interest is decreasing, controlling interest is increasing. So difference between the consideration paid and the decrease in NCI is an adjustment to equity, that is parents consolidated retained earnings. You will adjust in parent's consolidated retained earnings. Understand that. Then in SOPL, what we do, sir? Consolidate as a subsidiary in the full. For the full year, you will do consolidation, no such issue. But can I say the issue will come when? The issue will come when you are allocating the profit, when you are allocating the profit to parent and NCI. In that case, issue will come. So if in exam by chance question will not come saying that 6 months 60%, 6 months 70%, this complex question ACCA will never ask. You only have 1 hour to do the first question. This complex ACCA will never ask. If this question also comes, you should just write down in theory. Don't waste your time in doing calculation. If it comes 99.99%, it will not come only, as mentioned in the class also. Then sir, time apportion NCI based on the percentage before and after additional acquisition. The next one, sir, in balance sheet, what we do, consolidate the subsidiary as normal. But when we do consolidation, can I say the post acquisition profits, we have to see properly the NCI percentage, etc. So calculate NCI as follows. So this is the calculation, the form which you have to follow. See now here. First, you will write down what's an NCI at acquisition. When you acquire the control, let's take 2 years ago, we had control. So you will take at that date what is the value of the NCI. For the 2 years, you will give the NCI the post acquisition part from the date of till the date of step acquisition. Then NCA at the date of step acquisition you'll be getting. Yes. Then what we do? Then we this is the value of the NCA you got before the step acquisition. So now we will reduce the NCI. So how should we reduce, sir? Decrease in NCI at the date of step acquisition. So what will you do? You will take this B value. You will say, sir, it was 30% before. Now it is only 20%. So can I say decreases how much, sir? 10%. Decreases how much? 10%. So you will take the value of the NCA before acquisition, before step acquisition. You will multiply with the decreased percentage and divide by the total NCA before the step acquisition. Then you get what's the NCA after step acquisition. Then what do you do? NCA share 20% of post acquisition reserve from the date step acquisition is done, and NCA at the year end you will get. Now I mentioned this calculation should only be done when? Only if step acquisition is part way through year, that means mid of the year. You do. So in equity adjustment, what is this, sir? Fair value of the consideration which I pay. Why I'm saying it's a negative number? Because it's an outflow for me. So that you get this answer proper. Then, sir, decrease in NCA. So decrease in NCA, what is the formula? Sir, we take the value of NCA before step acquisition. We multiply the total interest which we had. And now we see what is the reduction. So we get the value. Then we have adjustment to parent. If I say I paid 100 and the NCA is only decreasing by 70, that means what? It is a loss for me because I'm paying more here. I'm paying more here. So this is a negative, this positive, automatically this comes, this is a loss and will reduce your retained earnings better. So NCA at the date of step acquisition will be how much? Into percentage purchase divided by NCA before step acquisition. This will be what? Reduction in NCI. Now the story which I mentioned you now, whenever theory question comes, no calculation, write down this. What will you do? If control to control is there, in that case, already control is achieved. So the adjustment will be done in equity. Goodwill will not be recalculated. We will decrease the value of the NCI and whatever is the adjustment we record in equity. So now chalo, what is the entry? Journal entry. Sir, cash is coming in. Cash is going out, credit cash, NCI is reducing, and whatever is the figure, balancing figure will be a gain or loss. So this was the case one from subsidy to subsidy. Now coming to case two, associate to subsidiary, a small part, very easy part, 15 to 45%. I had 15%, I shifted to 45. That means additional is how much here? 30% purchase. Now see here. Treatment. Investment measured either at cost or fair value. Yes or no? Can I say this 15% will be measured at what? IFRS 9, either fair value or either cost model. Fair value or fair value through P&L, fair value through OCI is treated as part of the cost of the associate. So what does this mean? Basically, one thing I say, no, assume that the investment is sold and repurchased. Assume the 15% is sold and assume that 45% is repurchased and do the calculation, you will get the answer. So see, in P&L, what should we do? Can I say before we only had 15%? Now we have it is an associate. So can I say we will apply equity accounting? IAS 28 we will apply as an associate from the date significant influence is given from the day. Then in balance sheet equity accounting as an associate IAS 28 day the day when we get significant influence. Simple now. See here now. IFRS 3 remeasure the existing investment at fair value on the date significant influence is achieved. That means this 15 percentage which you have no bete, you should remeasure the value at date when significant influence, and whatever is the difference will go to PNL. We'll go to PNL. See now. With any corresponding gain or loss recognized in PNL or OCI. Normally in PNL only. OCI when if the company is saying that we follow fair value through OCI for the investment previous, depending on whether the investment was previously measured as per IFRS 9. Then IAS 28 record both original investment and the new investment at cost on the basis that IAS 21 states under the equity method. So what should we do? The normal thing, what is the first thing we do? Cost, whatever is the amount which I paid for 30% plus what? Fair value of the right retained. Right retained. What is the right retained, sir? 15 percentage. Understand this. And now when the company is doing what? When the company is doing what? When the company was using IFRS 15, can I say if the company was using fair value through P&L, gain or loss recorded in P&L, no issues. But if I say the company is using fair value through OCI, the gain was in OCI, in that case, what we do? We should, can we reclassify this? Can we reclassify this? We can't reclassify. You will take to equity directly. Write down this sentence. You will get 1 marks. It will be taken to equity. So with this, investment to associate is done. Now, chalo, the next important part. Investment to subsidiary. Investment to subsidiary, associate to subsidiary. First, let us understand the concept now. See here. Sir, investment to associate. Sold, sell it. Investment in associate, remeasure it at fair value at the date of control, and gain or loss is recognized. So now see, gain or loss is recognized in profit and loss investing category. Yes or no? If I say this investment is valued as per IFRS 9, under IFRS 9 the company is using fair value through PNL or fair value through OCA. Same above what we have done just now, same thing only, nothing new in this. OCI. So what will you do? Investment previously held was an investment in equity and election was made to hold the investment fair value through OCI. Gain or loss will go to OCI. Then share investment was previously measured at OCA. Any amount recognized in OCA are not reclassified to PNL. It will go to equity. If you remember yesterday we had done financial instrument, the Reliance example. I mentioned increase the value of Reliance share price and then dispose of. Then you have to dispose of. The next one. This is the first thing. Sir, how do we calculate here? See now the calculation. Subsidiary is purchased. Calculate goodwill, including fair value of the investment previously held. So from 10% to 50 additional is what, sir? Total is how much? 60%. So what we do? Sir, fair value of the previously held investment is 10%. Yes, sir. Fair value of the consideration which you are paid to acquire additional 50%. Yes, sir. Then NCI at the date of acquisition depends on two methods: fair value proportion net asset method. Do it. Less fair value of fair value of net asset at the acquisition date. Then you will get what? Goodwill at acquisition. Then normal consolidation you do when the on the day control is achieved. Normal consolidation. So see treatment. Remeasure the investment at fair value at the date parent obtains control. Consolidate as a subsidiary from the date parent obtains control. In balance sheet, calculate goodwill at the date parent obtains control. Calculate consolidate as a subsidiary at the year end, and NCA also will come. If you're doing consolidation, for sure NCA will come. This was from investment to subsidiary. Next one, associate to subsidiary. Everything is same. Everything is same. What is the difference here? Instead, here the fair value of 10%, it will be 30%, 40%, depending upon the data. So, equity accounting as an associate to the date parent obtain controls. Until we get control, we should follow IAS 28. Remeasure the investment in associate to fair value at the date parent obtains control. Can I say in the books we record invest associate at what value? Cost? Cost plus profit. This, whatever is your carrying amount, you should remeasure this to fair value. Data will be given. This carrying amount, sometimes in some questions you have to calculate it, then compare to the fair value. Whatever is the difference will go to P&L. Remeasure the investment in associate to fair value at the date the parent obtained controls. Consolidate as a subsidiary from the date parent obtained controls. Calculate the goodwill at the date the parent obtained controls and consolidate it as a subsidiary. With this, I hope the step acquisition is clear to everyone. Any doubts in this? Yes. Okay. Chalo beta then. With this part is completed. Your step acquisition is done. That is, I hope there will be no doubts in step acquisition. Now, chalo to disposal. Disposal. Let us start with step disposal and full disposal both. Now, disposal. Disposal means what, sir? Loss of control. Either it can be loss of control or there will be no loss of control. So, disposal may be what? Full disposal. Entire shareholding is sold, or part disposal, retain some interest. That means today I had 70%, full 70% I've sold. That is no control. Nothing is there. From 70% only I sold 30. That means it becomes an associate for me. Or 70% I have sold 60%, 10%. Then I'll follow IFRS 9 year. Here I follow IAS 28. Same here. First, we should do what here? Till the day we have control, we follow consolidation. After that, we follow the respective standard. Understand that. Now, see here. When a shareholding in a subsidiary is disposed of, it must be reflected in both the books. That is, parents, company, individual financial statements, and group financial statement. In individual financial statement as well as group financial statement, we will record in both. So, gain to parent company in individual books. What should we do, sir? Gain on investment on disposal. What should we do? Whatever is the sale proceed, whatever is the amount I get, I will take it, less carrying amount of investment. This carrying amount of investment will be as per IAS 27 separate financial statements. This is a separate financial statements. Understand? In the individual financial statements or separate financial statements, the value will be recorded. Take that. Then you have a gain or loss. This gain or loss will be recorded where, sir? Investing category. Where it will be recorded? It will be recorded in investing category. Sir, in consolidated books, first case which you are doing is full disposal. So what we do if full disposal is that? Can I say we should do consolidation till the day we have control? And there will be gain or loss in case of PL. In the statement of financial position, at the year end, will you do consolidation? No consolidation. Subsidiary is not included in the balance sheet. Gain or loss on disposal is included in the retained earning. What the calculation? Understand here now. Sir, gain on disposal, sale proceed you'll write down. Whatever is the amount which you have received, we'll write down the sale proceed. Then we less carrying amount at disposal date. What is the carrying amount of the value which you are disposing of? How do we calculate this? CNO. Net asset at date of disposal. What is the value of net asset? This net asset is what, sir? 100%. Goodwill at the date of acquisition, 100%. What we do, we reduce NCI at the date of disposal. So why? Because this amount which we are paying belongs to 70% or 80% which we have, which we are disposing of. So it is important that we take net asset on the date of disposal. Net goodwill will take less NCI at the date of disposal. Now how do we calculate NCI at disposal? If you know, NCI plus post acquisition profits. Post acquisition profits till the date of disposal. Reduce it, you will get gain or loss. Now this gain or loss will go to operating category. It will not go to investing, because in consolidated books it's a business, no? So you will record this under operating category. So see, journal entry, debit bank that comes in, credit goodwill is going out, credit net asset is going out, NCA is reducing, whatever is the balancing figure will be a gain or loss. Will be gain or loss. I hope with this your this part is also clear. Now coming to part disposal. Part disposal, what will happen in part disposal? In case of part disposal, some part will be disposed of. See now, first one is control is retained. Even though we are disposing of, still we have control. Example, subsidy to subsidy, 80% to 70%. The next one, sir, control is lost. Control is lost, that means no control. Can I say full disposal? We have already covered above. No shareholding. Subsidy to associates, the control is lost. That means 70% to 35. Till the date we have control, follow IFRS 3 and IFRS 10. After that, follow associate accounting. Sir, subsidy to investment. from subsidiary to investment. Till the day we have control, follow IFRS 3, IFRS 10. After that, follow IFRS 9. Now, here NCA is increasing or decreasing here now? Here NCA will increase. NCA will increase. So let us do the first case. Control is lost, full disposal. Already we have discussed this. Now coming to partial disposal. Parent dispose of some of its shareholding in a subsidiary. Control is lost, but remaining as an associate or investment. So first we are discussing partial disposal. Then we'll come to what? Your control to control. Then now what is the thing, sir? Group profit or loss. We are calculating for group. For individual books, I've already mentioned. Take the carrying amount and take the sale proceeds. Done. Now see here, fair value of the consideration received, sale proceed. Here, what is the assumption? In case of step acquisition, the assumption was sell and repurchase. Here it is what? Here it will be what? There we sold the 10% and acquired the 65%. Here it will be what? Sell the full company and again repurchase the shareholding. Today, if I have 70% and I am selling 40%, that means 30% I have. So, what is the general assumption? We sell full 70% and reacquire 30%. See here now, fair value of the consideration received, you will take this fair value of the retained interest. So if today I had, let us take 70 to 30 only same. So my fair value of the proceed will be for 40%. My interest that is retained is what? 30%. Then what? Less interest in subsidiary disposed of. Net asset at the disposal date, goodwill at disposal date, less carrying amount of NC at disposal date. You will get this value. This value will reduce. So you will get your gain or loss. This gain or loss will be shown in operating category. Operating. This formula will be repeated for both the things here now. Then chalo, subsidiary to associate, sir. First thing, this is the general principle which we follow. Now see it, subsidiary to associate, 70 to 35%. Consolidate as a subsidiary up to the date of disposal. Group profit or loss on disposal in the operating category. Treat as an associate from the date control is lost. Now, when you treat this as an associate, can I say my remaining was what? 35. That 35 should be taken at fair value, better. Should be taken at fair value because here we are considering what? The fair value of the retained interest. Whatever is the difference, it will automatically be adjusted here now, gain or loss. Now, consolidated statement of financial position. Remeasure the investment retained at fair value at the date of disposal. Remeasure equity accounting associate from the date control is lost. In balance sheet, how will record investment in associate in P&L, share of associate profit. This was the case one. Case two, subsidy to investments. In that case, what we do normally, same. What we do, you'll write down the instead of here now 30%, I can say it is what now 10%. It will be what 10%. So I am selling 60%, 10% is the value. This 10% once the control is lost, it will be treated as per IFRS 9, either at fair value through P&L or fair value through OCA, depending upon the company's choice. Then we saw less value which you have disposed, net asset on date of acquisition, goodwill at disposal date, and less carrying amount. Now this net asset at disposal date, how will you calculate it? You should take the asset on the acquisition date plus post acquisition profits and any other adjustment like fair value adjustment, etc. Do that. Consolidate as a subsidy up to the date of disposal. If I say after 6 months we are disposing only for 6 months, P&L will be consolidated. Group profit and loss on disposal in operating category. Treat as an investment in equity instrument from the date control is lost. Either fair value change in P&L if fair value through P&L and OCA if fair value through OCA. Any dividend income received in P&L under investing category. So then, consolidated statement of financial position. Remeasure the investment retained at fair value at the date of disposal. Investment in equity instrument from the date control is lost. Simple. So with this, the case is clear. Three cases: full disposal, your subsidiary to investment, subsidiary to associate. Now coming to subsidiary to subsidiary. In this case, what should we do, sir? Disposal where control is retained, decrease in NCA. Can I say the adjustment will be done in what? The adjustment will be done in equity here. So treatment, increase in NCA in the consolidated financial statements, difference between the consideration received and increase in NCA as an adjustment to equity. So parents retain earnings will take a hit here. Then sir, in P&L what should we do? P&L you'll normally consolidate fully, no issues. But what should we do? time apportion the NCA before and after acquisition, the profit which we give them. Then in balance sheet, what should we do? Consolidate as a subsidiary at the year end. Calculate NCA as follows: 80% to 70%. Now see, NCA at the acquisition date, that was how much, sir? 20%. Because before we had how much? 80%. NCA share of post acquisition profits from the day when you acquire the control till the date of disposal, step disposal. You will get NCA at disposal date. Then you will see what? Increase in NCA. What will you see? Increase in NCA. How will you calculate this increase in NCA, sir? You will take the B value. You will apply 10%. The previous, it was how much? Previous, it was 20%. Now, how much is the increase, sir? 10% is the increase. So, you will add here. In the above case, we had reduced in the step acquisition. Here you will add. So you'll get NCA after disposal, then NCA share of post acquisition profits. Now it will be at 30%. So this will only be done if the disposal is part way through, I mentioned, and NCA at the year end you will get the value. So the equity adjustment is what, sir? Fair value of the consideration which you receive. NCA is increasing. So whatever is the increase, can I say 10% and 20? So you will record this as a negative. If it's a positive, it's a profit. If it's a negative number, it's a loss. That means you're receiving how much? 200. And I say the NCA is only increasing by 120. That means it's a profit for you 80. You're receiving how much? 200. But how much is the value that you're losing? 120. So NCA at disposal percentage and NCA before disposal. What is the sold percentage and divided by this? Now a very important line, this one. Sometimes what will happen in the exam, no? It will be difficult for you to calculate the NCA value at disposal date. It will be what? Difficult for you to calculate the NCA value at disposal date. This is only for which one? Only for step disposal. The increase in NCA will be the share of net asset. Okay, whatever is the net asset on the date of disposal, always, and goodwill if it is at fair value method. So what you normally do, sir, you say NCA at disposal date. Then what you do? NCA at disposal date. That means before step disposal. You will take that 100 into, you do 30, 20 divided by 10% into 10 divided by 20%. Now this 100, either I've mentioned the formula. Sometimes in the question the data will not be given, but what the data will be given? They will give the net asset at step disposal. Then take this value and multiply with the NCA percentage. Your NCA will remain same only. If it is full goodwill method, then what will you do? You will take this net asset plus goodwill you will take, and then you will apply on this 20%. You will get the value of NCA. Then take this value of the NCA and proportionate and get the value. I hope everyone have understood this part which I have explained you. Now see, what is the journal entry we pass? Debit cash that is coming in, credit NCA increasing, debit or credit will be a gain or loss. It will go to group retained earnings. So with this is done. Then coming to deemed disposal. This deemed disposal has not been tested by its same as your step disposal. Now deemed disposal will occur when, understand. Today parent company is there, subsidiary company is there. Now parent company has 60% of subsidiary company. So that means 60,000 shares parent company. Total shares are what? 1 lakh shares. Now subsidiary company in future will issue shares. They want to raise capital. They are issuing further shares, 1 lakh shares. Now, when they issue this 1 lakh shares, they have given the first priority for parent company to purchase this. Now, the parent company will say that we will not purchase. Can I say if the parent company will not purchase this, what will happen? Can I say total shares will be 2 lakh and now parent company only have 60,000? That means what? Only the percentage is 30. That means control is lost here. This is deemed disposal. Deemed disposal occurs when a subsidiary issues shares and the parent does not take up all its rights such that its holding is reduced. Treatment: deemed disposal is consistent with that of an actual disposal depending on whether control is lost. Whatever we have done above, same thing only. Nothing difference. Copy, paste, same. I hope everyone understood the deemed disposal concept. That is the reason it is not tested, because it's same like your step disposal. Now coming to the presentation. Whenever a company disposed of a company, how will they present in the balance sheet? In the balance sheet. Now if you remember, in your PN, in your balance sheet, what do you do? If you dispose of a subsidiary, you remove everything. You do not consolidate on it. But what we will do in PNL, in PNL, either you can do line by line adjustment, each and everything you will do 6 by 12, 6 by 12, 6 by 12, 6 by 12. Or the other thing which we can do is what? Discontinued operation as per IFRS 5. When you dispose of any subsidiary, IFRS 5 will come into picture. So what we normally do, then we show only in a single line adjustment saying that profit or loss from discontinued operation. So this detailed calculation, where will you show? The detailed calculation of the uh, subsidiary will be shown in the notes to accounts. And in this, you will include the gain or loss on disposal also. So see here now. Time apportionment line by line. Traditional approach. Income and expense of subsidiary are consolidated up to the date of disposal. Profit and loss on disposal of the subsidiary is represented separately in operating category. Discontinued operation. If a subsidiary qualifies as a discontinued operation in accordance with IFRS 5, non-current asset held for sale and discontinued operation results are aggregated into a single line item on the face of P&L. So represents immediately after profit for the period from continuing operation. Once you write down the profit from continuing operation, after that we. So this includes what? The single line adjustment will include what? Sir, profit or loss from subsidiary up to the date of disposal and profit and loss on disposal. You will not say this two, you will not write down 2 points, only one thing will write down, but the calculation will be shown in notes to account. So with this, I hope this is clear to everyone. Then coming to the last topic of disposals, significant influence is lost. That means I had 40 percentage, from 40 percentage it is going to 10%. In that case, same whatever we have learned above, same we have to do. See here now, disposal of all or some of the shareholding in an associate are the same as those for subsidiary. However, gain or loss on disposal of an associate are shown in the investing category of profit and loss. Full disposal, that is 35 percentage to 0. So you fully dispose. If you fully dispose, that means what? You will have gain or loss on the sale of associate. So whatever is the fair value, the consideration which you have received to sell the associate, less the carrying amount of the how do you calculate the carrying amount? Your IAS 28 equity accounting, we follow that and we do the accounting treatment here. Less impairment of, you do this and calculate the gain or loss. This is recorded in investing category. Now I say financial asset is retained. That means from 35% you are going to 10%. Then fair value of the consideration received, fair value of any investment retained, the less carrying amount of the investment in associate, you will take this into consideration. And this is the value you reduce. And whatever is the balance will be a gain or loss in investing category. And the remaining, this fair value will be treated as per IFRS 9. See now. Equity accounting associate up to the date of disposal, profit or loss on disposal in P&L category, fair value changes and dividend income after disposal in P&L. In balance sheet, remeasure the investment remaining at fair value at the disposal date, investment in equity instrument after the disposal. Once you dispose, after that we will follow this account. So with this, your step acquisition and step disposal is done. Any doubts still here to anyone? I hope there is no such doubts. Now, chalo, let us start with the IFRS 11 joint arrangement, the favorite topic of the examiner for theory. Here, for sure, theory question. So, as of now, I mentioned control, business combination, identifiable assets, acquirer, joint venture. The fifth type of theory question, which is frequently repeated in the exam. Now, what is joint arrangement, sir? An arrangement in which two or more parties have joint control. Now, what does joint control means? An agreement in which two parties have joint control. Joint control means what? The contractual agreed sharing of control of an arrangement which exists only when decision about the relevant activities require consent of both the parties. Both the parties should provide the consent. If I say today a company is there and this company I have joint control. Joint control is with I am X and the other person is Y. So that means both the parties should give consent. Then only we can move forward. If I agree, Y is saying no, we can't do anything. Both the parties should agree. Consent of both the parties is required here. That means unanimous consent of both the parties is required. Joint control has the following characteristics. Parties are bound by the contractual arrangement. Contractual arrangement gives two or more of those parties joint control of the arrangement. That means they'll have joint control. Joint control means what? Consent of both the parties is required. Then chalo, types of joint arrangement. There are two types of joint arrangement. The question will be from this only. Joint operation and joint venture. So now what the joint operation means and joint venture, understand here. Question comes, you have to write down this, the one which I've written in red here. Joint operation, a joint arrangement where the parties that have joint control of the arrangement and have rights to the assets and obligation for the liabilities relating to the arrangement. That means in joint operation, I will have rights to the asset and obligation to the liability. But sir, in joint venture, a joint arrangement whereby the parties that have joint control of the arrangement and have rights to the net asset. Here I have the right to the net asset, but here I have what? Right to the assets and liabilities. Parties are called as joint operators here, and parties are called joint ventures. So here what will apply, sir? We will apply IFRS 11. Here we'll apply IAS 28. So if it is a joint venture, we apply what? IAS 28. We do the accounting as per equity accounting, same as your associate accounting. Now see, classification of joint arrangement. If the company is creating a separate entity, to identify joint operation or joint venture, you have to see the concept of separate vehicle. Separate vehicle means separate entity. If the joint control which you have is not through a separate entity, then it is joint operation. It's joint operation. We will do what? Line by line accounting. Line by line accounting means what? If today it's a joint operation, if I say I have 40% in that, whatever each and every item, asset, liability, equity, income, your income, expense, everything I'll multiply with 40% and include in my balance sheet and P&L. But if it is structured through a separate vehicle, it can be a joint operation or joint venture. In your exam, the question will be straightforward and easy. It will not be complicated. So for joint venture, we follow what's a equity account. So see, how should you identify? Entity should consider three important things: the legal form, terms of the contractual arrangement, and other facts and circumstances of the case. So see, the first case, legal forms gives the parties right to the assets and obligation. In that case, what? It's a joint operation. Even though separate entity is created, but the agreement which is done between the parties says that we have the right to the asset and obligation. Right to the asset and obligation to the liability, then it's a joint operation. Then, sir, if no means obtain further information, that means you have to see the second thing. Terms of the contractual arrangement specify that the right parties have the right to asset. Even in the contract, nothing is mentioned. Contract, nothing is mentioned, but X and Y will agree that okay, we have the right over the asset and obligation to the liability. In that case, also joint operation. If this is if this is not there, then see for further information. Further information is what? Is the arrangement set up in a way where it mainly gives output to the parties and regularly depends upon them to pay its debt? Yes means it's a joint operation, no means it's a joint venture. So that means what? Understand. X is there, Y is there. They have started a company known as Z. So basically, when they start a company, it should be what's a joint venture. But you have to see further cases here now. You have to see further data. If I say the output which is generated by Z is given to X and Y only. Whatever they manufacture, whatever company Z will manufacture will be given to X and Y. In that case, what we say, the output is given. And the Z company will be dependent on these two parties only for cash and for the repayment of loan. Then we say it is joint operation only, it is not a joint venture. If I say the Z company is supplying to other parties in the market also and they are getting payment from them, and the Z company is not dependent on these two parties, then we say it's a joint venture. If the examiner will ask you, the examiner will ask the third point only. So I hope this is clear. Now accounting treatment for joint operation. See, in separate financial statements, a joint operator requires it assets, including its share of any assets held jointly. Yes, Beta?
So there was a question, I don't remember where, but they had told in the question that two or three entities give guarantee about a loan repayment
Mm-hmm.
of a particular entity, and they also have the right to net assets as well. So the
Mm.
question's conclusion was it is a joint venture, even though it is giving guarantee to pay off its liabilities. Because
But
they're saying giving mere guarantee is not considered as giving rights to assets and obligations.
Guarantee, see, guarantee means what now? Here, but in the question they mention net asset, no? In the question
Yes.
they mention net asset, so it will be joint venture only. This, why did I mention? When I say this you should consider when they have the right to the asset and obligation, not for the net asset part. That is the reason.
Okay.
See, that is the reason I've written joint operation. Then we'll come to this conclusion. If it is net asset means what? We already know. And they mentioned that 2 or 3 parties have this. But you have to, in your practical, in the practical world, it is easy to identify. But in the question, if they just mention net asset, you have to take what it is, joint venture.
Okay.
In your exam question you have to see 2 things only. Joint for joint venture separate vehicle net asset, say it, no issues. But this third one is when it is confusing. If it's confusing, like we have the right to the asset and liability and entity is created, then we follow these 3 points.
Okay.
Okay. Its asset including its share of any assets held jointly. So what we do, we record the asset value of the joint operation plus what we do, whatever is my share in that. Then each liability, each revenue and expense, everything will be taken. So if I say my company has a what, 10,000, and in the joint operation which we have done, in that revenues, let's say 7,000, and I have 50% in that. So what will I do? I'll simply include 50%. It's like consolidation only, but it's not uh, same as consolidation. It's similar. We can say it's similar. You'll add each and everything here. So accounting for any asset, liability, revenue, income will be in accordance with relevant standard. No adjustments are necessary on consolidation as the figures are already incorporated correctly into the separate financial statement. So what will the company do if it's a Reliance company and Reliance says that we have formed, it's a joint operation, then Reliance company in separate financial statement will record its revenue, income, expense, and whatever is the percentage in this joint operation they will record. When you prepare consolidation, you need not again include it because it is already included in the individual and separate financial statements. Joint venture, separate financial statements. Investment in JV will be reported as per IAS 27, cost, fair value, or equity method. Where joint venture has no subsidiary, the equity method must be used. Here, this is an important point which is mentioned in IAS 27. Now, the company in its separate financial statements can use what? Can use IAS 28 when there are no subsidiary company, there are no subsidiary company, then only we can use equity method. If there is any subsidiary company in separate financial statement, we can't use equity method. We have to use cost and fair value only. Consolidated financial joint ventures are accounted for using equity method in the CFS, same as IAS 28. Share of joint ventures investing category in the statement of profit and loss. I hope everyone have understood this part. Now, some special transactions which we have discussed, I have not seen this being tested, but let us do. Even though sale or contribution of asset to a joint operation, that means what? If today I am selling some goods to a party, that is which party? That is the joint operation. In that case, what should I do? That joint operation will have some profit. That profit will be what? Total profit. Yes or no? Out of the total profit, only the profit of today if I'm selling some goods, I am making some profit. Out of that profit, only the share of other parties profit I should record. I should not record my profit. If you record that, it will be double count. So the joint operator sells goods to a joint operation at a profit or loss. The joint operator will only recognize the profit or loss to the extent of other parties interest in the joint operation. The next one, purchase of asset from a joint operation. Same. If a joint operator purchase goods from the joint operation, it must not recognize its share of any gain or loss until it resells the asset to an external person. So today what? If it's a Reliance company and this is joint control. Normally I sell a, I should do what? I should record gain, but I will not record this gain until this joint control will sell to someone else. So with this is also completed. Then coming to IFRS 12, disclosure. Not so important, but let us see the 5 to 6 basic points. Now IFRS 12 is what? Disclosure of interest in other entities. Interest in other entities includes subsidiary, associate and joint arrangements. Objective is enable users to provide, it helps or enables users to get the information to make the right decision, and it will help them to identify what is the risk, etc., xyz. So what are the main disclosures? The main disclosure are what? Entity is required to disclose any significant judgment and assumption which they have taken to say whether it's my associate, joint venture, or joint arrangement. So they have to write down, they have to mention what is the judgment you have taken to decide whether control is there, whether joint control is there, or significant influence. Then why this should be given? This should be given so that the composition of the group is mentioned and the interest of NCI, so that the stakeholders will get to know, okay, in this company this is the control we have and 30% belongs to NCM. Then the nature, extent, and the financial effects of interest in joint arrangements and associate, including the nature and the effects of the entities contractual relationship with other investors. They also have to mention what are the relationship with other investors, etc., xyz. Then the nature and the extent of interest in unconsolidated structure entity. If it's you have not consolidated, etc., what is the reason why you have not consolidated, mention that also. Then any significant restriction is there on the entity? Does the entity have any significant restriction on any one of the entity, like significant? If today I have a control, but with that control, is there some restriction or not? Is there some restriction? Please provide the disclosure. Then if you're losing the control of the subsidiary, what are the consequences? You have to mention that. Then the risk associated with the entity's interest. If what is the risk associated, like in case of a joint venture, associate, unconsolidated structure entity, etc., any commitment is there, any contingent liability, etc., xyz. Because we have seen, when we do consolidation, we take into consideration what? Contingent liability as a provision. But if you're not doing consolidation, if it's your associate, but can I say, when you have a significant influence and that company has a contingent liability which is recorded and it is a huge amount, they've only disclosed it's a huge amount, but this will affect your profit also in future, you have to disclose that. With this, the disclosure part is now coming to the IFRS 19, very important, the new standard. So please listen carefully. IFRS 19 means what? Subsidiaries without public accountability. So this will apply to what? Subsidiaries. Subsidiary, when it will be a subsidiary, when control is there. Without public accountability. Now this without public accountability you cover in SME also. So now see here. IFRS 9 sets out reduced disclosures. That means if a company is there, today a subsidiary company, this subsidiary company will prepare its separate financial statements and individual separate financial statements. Now this subsidiary company will have a parent company. This subsidiary company will follow what? IS and IFRS. Now, when they follow IS and IFRS, can I say a lot of disclosures should be given? A lot of disclosures will be there that should be given. But IFRS 19 says what? If it is a eligible subsidiary as per the conditions mentioned as per IFRS 19, this subsidiary need not provide the disclosure as mentioned in the standards. IS2 is there. IS2 will give you a disclosure requirement, a very big disclosure requirement. In that case, the subsidiary, if it's an eligible subsidiary, if it meets the definition of eligible subsidiary as per IFRS 19, it need not provide the detailed disclosure. It can provide reduced disclosure. And the reduced disclosure, the disclosure which you are reducing, which should be very important. It should be material and it should be important. If you have seen in IFRS 18, IFRS 18 says what? Even though IS and IFRS will say you to provide the disclosure, but IFRS 18 says if it is not material, if it is not relevant, do not provide. Do not provide the disclosure. But now the subsidiary can do what? The subsidiary can reduce the disclosure. So if they reduce the disclosure, can I say cost will be saved? So it's a cost benefit analysis as per your conceptual framework. That principle is also applied here. So we see here is permitted to apply. So reduced disclosures are permitted to be applied as per other instead of other accounting standard. So instead of following other accounting standard, the IFRS 19 says that follow IFRS 19, whatever we are mentioned in this for reduced disclosure part. But the recognition, measurement, presentation, everything will be as per the old standard only, as per other IS and IFRS. Only for disclosure part, you should refer IFRS 19. Standard applies to reporting entity commencing on 1st Jan 2027 with early adaptation being permitted. Means before that also the company can apply, no issues. IFRS 19 is a voluntary standard for subsidiary. It's voluntary. If they want, they can choose. If they do not want, no issue. See, many companies will use this because it will save their cost. Eligible subsidiaries can elect to apply IFRS 19 when preparing either consolidated books, separate or individual financial statements. When it's an eligible subsidiary, when they are preparing consolidated books, separate financial statements or individual financial statements, they can apply this reduction of disclosure in each and every case. Now, sir, the question comes: what is eligible subsidiary? Whenever a question comes, if you're lucky, if you get a question of for IFRS 19, please write down this. The question will be straightforward only. Write down this point. Write down this 2 marks. Eligible subsidiary. What is an eligible subsidiary? A subsidiary that does not have public accountability. A subsidiary that does not have public accountability, and its ultimate or any intermediate parent company produces consolidated financial statements available for public use that complies with IFRS accounting standard. Just when we started the session, we discussed this. That means if a parent company is the subsidiary, this subsidiary need not prepare consolidated books when the ultimate parent. So same way here also. So now, to be eligible subsidiary, it should be what, sir? Public accountability should not be there. When will you say public accountability will not be there? It equity or debt instrument should not be listed on the stock market, or it should not be in the process, and it should not be a bank or any insurance company, because if it's a bank and insurance company, they have fiduciary duty to disclose the financial statements or to provide information to the stakeholders. So does not have public accountability, it ultimate or any intermediate parent company produces consolidated financial statements available for public use that comply with IFRS accounting standards. So see here now, public accountability means what, sir? When will you say a company has public accountability? Debt or equity instruments that are traded in public market, or it is in the process of issuing for trading in public market. It holds asset in a fiduciary capacity for a broad group outsiders as one of its primary business. Example, bank, insurance company. These companies will have fiduciary duty, even though they are not listed, but they have to disclose the information. Why? Because they are having the public money. It's important for the public trust, so that they disclose the. In that case, that will not be a eligible subsidiary. Now see, eligible subsidiary must continue to apply recognition measurement. This also will carry 1 more marks. Maximum the question will come for 5 marks or 6 marks, not more than that. IFRS 19 question will come for this. Recognition measurement presentation requirements of other IFRS accounting standards, but the disclosure requirement will be those under IFRS 19, the reduced one. Entity must comply with the full disclosure requirement. Okay, they can follow what? Reduced disclosure. But for these three areas, you can't reduce the disclosure. IFRS 8, your operating segments, you should provide each and every disclosure that is mentioned in your IFRS 8. IAS 33 EPS, same thing you have to provide. Then IFRS 17 insurance contract. In these three cases, reduced disclosure will not apply. Then next one, sir. An entity may elect to apply IFRS 19, revoke that election in a period and re-elect it again in a future period, provided it continues to meet the eligibility criteria. That means today the company can apply IFRS 19, again they can stop, again they can start, again they can stop, again they can start. It can continue n number of times. There is no limit here. So this is the IFRS 19. Now IFRS 19, the question will be straightforward. They will give you a subsidiary. They'll say that it has accountability, etc. Whether this whether is this eligible subsidiary, you will say no, etc. XYZ. Now see here in the see here now, in our regular class we have done this eligible entities. I mentioned eligible entity means what? It should meet the definition of IFRS 10, it should be controlled and does not have public accountability. Yes or no? So for public accountability, I mentioned what? Equity or debt instruments are not traded, or it should not have some fiduciary duty like responsibility. And the entity has an ultimate parent which prepares the consolidated financial statements in accordance with IFRS. All the three conditions should be satisfied at the end of at the each reporting period. Then we say it's what? Your eligible subsidiary. Now see here, a parent company is that this is the ultimate parent. It prepares consolidated financial statement. This has a subsidiary, and this subsidiary has no public accountability. Can I say this will be eligible subsidiary? Yes, sir. This subsidiary has a further subsidiary. Subsidiary R, subsidiary L. This subsidiary R, can I say control is there, no public accountability, and the ultimate parent is preparing the financial statements. In that case, this is also eligible subsidiary. But I say subsidiary L is there. This subsidiary L is what? It has public accountability. Its shares or stocks are traded on market. In that case, this will not be eligible subsidiary. The next one, parent A is the ultimate. Now I said the subsidiary A is there. No, this subsidiary A shares are listed on the stock market. This will not be eligible subsidiary. Then public accountability. Then subsidiary are subsidiary. Can I say subsidiary are no public accountability control is there? Then ultimate parent is preparing, all the conditions are being met. Then eligible subsidiary. But this subsidiary L is a have public accountability, then this will not be eligible subsidy. So these, if this company is not eligible subsidy, this will not affect this one. This company, you have to see the ultimate parent. Intermediate parent is not preparing, but can I say the ultimate parent is preparing? In that case, this is the point. All this we have covered. This we have covered. Yeah, we have covered this part. So with this, IFRS 19 is done. Any doubts in IFRS 19? Anyone? Very important. So I have shared in the group the question regarding this one. So please do it. It was a straightforward question. And in your past papers also, we have one of the question and we have done it. So with this, your this part is completed. Now the last topic from the consolidation, foreign operations. What is this? Foreign operations. Now foreign operation basically means understanding. Today, a parent company is there in India, that is Reliance. Its subsidiary company is in US. If subsidiary company is US, can I say the subsidiary company will prepare balance sheet in and period in dollars? Reliance will prepare in rupees. But now this is a group. Now, when it is a group, can I say they have to prepare consolidated financial statement and they have to give this to SEBI. They have to submit this to SEBI in India. Now, can the company consolidate a balance sheet and a P&L with rupees with a dollar? No. No, it creates a issue. So what should the company do? Whatever is the exchange rate at the reporting date, it should be converted. So dollars will be converted to rupees. And when you convert the dollars into rupees, here and there, some exchange gain or loss will be there. That exchange gain or loss should be recorded in OCI. Let us see now. So see, I hope everyone understood the basic. Foreign operation, an entity that is a subsidiary, associate, joint arrangement, or branch of a reporting entity, the activities of which are based or conducted in a country or currency other than those of reporting entity. Functional currency of foreign operation is what? Foreign currency should determine its own functional currency and prepare its financial statements in that currency. So functional currency is what? Currency that the currency of the primary economic environment in which the foreign operation operates. Basically, in the example which I have taken is US dollars. Then, sir, additional factors are set out in the standard to determine whether its functional currency is same or not. This I have not seen being tested. As of now, we will not do this. It's not required also. But understand, in your exam question, every time it will be mentioned what? That this Reliance company and the company which is in US are independent. They are not interrelated. So in that case, what will happen? This company's function currency will be dollars, it will be rupees. But if I say Reliance is there and Reliance has one company in US, and that US company, whatever Reliance says will do, whatever goods and service Reliance will provide, they will sell that only. And whatever profits they generate, Reliance will have the power to take it back whenever they want. In that case, the functional currency and the foreign currency will be same only. So then the concept of foreign operation will not come into picture only. This is as per IS 21 in detail. That is not tested also, but for understanding purpose, I mentioned it. Now coming to translation of presentation currency. That means you want to prepare your balance sheet, you have to translate it. You have to translate the financial statements now. Financial statements of foreign operations are translated into the presentation currency of parent company. So presentation currency means what? The currency in which the financial statements are prepared. Translation gives rise to exchange gain or loss, which is reported as OCI of the foreign subsidiary and accumulated in foreign exchange reserve. So what will you do? You will record in OCI and you will take this to what? You will take this to, you will take this to OCE under which under a new heading known as foreign exchange reserve. Can this gain or loss be reclassified? Anyone? Can this gain or loss be reclassified? The exchange gain or loss. Can we reclassify this to P&L? Chalo, say me. Can we reclassify this to P&L? Say me, anyone? Can we reclassify this to P&L? Chalo. Now, in case of SOFP, in case of a balance sheet, how will you consolidate? Asset and liabilities will be the exchange rate. Which one will use? The closing rate. Exchange rate at the reporting date, the closing rate. Share capital and pre-acquisition retained earnings, historic rate, historic exchange rate at acquisition date, control is achieved. So the share capital and pre-acquisition retained earnings will be converted using which rate? The rate on the date we acquire the control. IAS 21 is silent on the rate to use for equity balance. For example, but the historic rate should be used, because when you see the retained earnings will include the profit. So for profits, it is better to use what? For profit, it is better to use your average rate. But here we will be using what? We will be using the rate on the day when you get the control or the control is achieved. And then post acquisition reserves. So in post acquisition reserve, what, sir? Profit or loss? Profit or loss, what will you do? Profit and your OCI, you will convert this based on what? Average rate for each year. Average rate. Dividend, you will convert this at what rate? Exchange rate on the date the payment is done. So now see here, this. So you will have the gain or loss on two things: net asset, profit, and goodwill. So for net asset and profit, we do this calculation. So normally, what should you do? In your ACCA SBR exam, the examiner will never ask you to prepare a full consolidation statement or a consolidated financial statement for foreign operation. No, they'll only just ask you the part. So here now, can I say first what you'll do? You'll calculate the opening net asset, you'll add the profit, you'll get the closing net asset. This you will do as per the foreign currency. Then what will you do? Then you will convert this into the functional currency or the presentation currency. Functional currency and presentation currency of the parent company will be same, 99.99%. So now opening rate we will take the opening rate, we will multiply. Then for profit and loss, we use what? Average rate. I mentioned opening net asset, opening rate, closing net asset, closing rate. For dividend, date on which the payment is done. For profit and loss, we will use the average rate. Now when you use the average rate, you get the answer. This you will get 100 plus 20, you get 120. But when we do the closing, we are getting 140. So can I say that is a 20 difference? This 20 is what? Your gain, because the value of the asset is increasing. This gain is what? Exchange gain or loss. In P&L, what will you do? In SOPL, what will you do? Each and everything you will convert all at average rate. Yes or no? Average rate. So now see, so for net asset, I hope there is no doubt. How do you calculate the exchange gain or loss? You just take the opening net asset, you just take the closing net asset, profits, and multiply, and whatever the difference will be exchange gain or loss. Then chalo, for goodwill For goodwill, what will you do? Oh yeah, this one. This is the calculation for goodwill. So see here now. Goodwill, sir. Consideration transferred. Presentation current. That is historic rate at the date control is obtained. Everything you will calculate. Normal goodwill you will calculate. This is your goodwill at acquisition. Then you have impairment loss. The impairment loss will be converted at what, sir? Will be converted at an average rate. Then your goodwill at the closing rate you will apply the closing rate, and whatever the difference will be your exchange gain or loss. So the easiest method is to do what? The easiest method is this one. See, you write down the opening goodwill in foreign currency. Impairment you write down, exchange gain or loss will be getting, and closing you'll record. So exchange rate, what is the exchange rate? Opening rate, closing rate, average rate. Now this is the value, this is the value. You compare these two figures, whatever is the difference will be your exchange gain or loss. Will be your exchange gain or loss. Will be exchange gain or loss. So the exchange gain or loss we have calculated on the net asset and profit, and we have calculated on the goodwill calculation. Now, now this exchange gain or loss which we calculate on the net asset and profit and goodwill, we should allocate it. We should allocate it. So see here now. Note, consolidated statement of P&L, exchange difference is allocated between the parent and NCA in the same way as different types of OCA. Yes or no? Whatever is the exchange gain or loss which you get will be allocated to whom? Parent and NCI. In SOFP, difference exchange gain is allocated between parent and NCI. For NCA, what do? For NCA, you reduce the value from the NCA value. For the NCA, whatever is the exchange gain or loss which belongs to NCA, in the step number 4, you will reduce it. But for parent, what will you do? For parent, you will present in a separate line item known as what? Consolidated foreign exchange reserve. Foreign exchange reserve. So, what is the frequently tested adjustment here? The examiner will say that the question will say the exchange gain or loss is recorded in retained earnings. We have done one exam type of question also, that the examiner has, the question says that the exchange gain or loss is recorded in retained earnings, but this is wrong. Can I say for parent company we have to create a translation reserve, exchange gain or loss reserve, and for NCA we will reduce. So what will you do? Here they have reduced the loss, so what will do? I will come and add it back here. I'll increase my retained earnings. I will record in translation reserve as a loss of 90 for the parent and 10 as a loss for NCI. So you have to do this. This is the frequently tested adjustment. Then see now, goodwill. Exchange difference is allocated between the parent and NCA if NCA is measured at fair value. Yes or no? If it is at fair value method, the exchange gain or loss will be allocated to parent and NCA. But if goodwill is at proportionate net asset method, then whatever is the exchange gain or loss you get will be allocated to parent only. And goodwill impairment is shown under which category? Operating category. See here, otherwise only to parent. Which method? Proportionate net asset method. So I hope with this, the foreign subsidiary calculation you have understood. Now I have written your steps. How should you do the step for balance sheet and P&L so that you get your answer. So let us see the steps once, even though the examiner will never ask you the full question. So see the step number 1. Step number 1 is what? Translate P&L items. When you translate the P&L items, I mentioned at what rate you will do the translation. At average rate. Use the average rate for the period. Your revenue, income and expenses all will be converted based on average rate. Then what? Calculate the profit. After translation, compute profit for the year in presentation currency. You will do the total of the profit. Then step 3, include OCI items. Yes or no? You will include the OCI item. OCI items will be what, sir? Foreign currency translation gain or loss from the net asset and profit, foreign translation gain or loss on goodwill. Both the things will come. Then step number 4, total comprehensive income. What will you do? Step number 2 plus step number 3. Then calculate the share of NCA. Take the subsidiaries translated profit and OCA, apply NCA percentage, then determine the holding company. That is what? The parent company. Subtract NCA percentage from the total comprehensive income. For P&L it is simple. For SOFP, what should we do, sir? First, translate balance sheet item, all the current asset, non-current asset, non-current liability using closing rate, line by line. Then line by line consolidated, add non-current asset, current liability, non-current liabilities. Step 3 is what? The calculate net asset of the subsidiary. Your step number 2, which we have done. So determine net asset at acquisition date and closing rate in the foreign subsidiary, foreign currency. Then calculate post acquisition profits and split it between parent company and NCA using the average rate. Normally, what we do, your date of acquisition, reporting date you do, you get the post acquisition profit. This you take where? This we give to parent and NCA. Then step number 4, so step number 4 is translation working. So take the opening asset, closing, opening rate, average rate, and this closing. You get what? You get the difference here now. You'll take this z value, you'll add x plus y, you'll get the difference. This is what, sir? This is a foreign currency gain or loss. Now this is an OCI item. Now this, can I say, should be given to whom all? It should be given to parent and NCI. For NCI you will reduce from the NCI value. For parent will create a foreign exchange translation reserve, a reserve account. Step number 5 is what's a determine goodwill on acquisition in foreign currency, normal. Then translate the goodwill. Opening goodwill, closing, and impairment. Opening rate, average rate, do this, you get the difference. The difference is what, sir? The difference is what? Your exchange gain or loss. This exchange gain or loss, can I say, should be given to parent if it is proportionate method. This, if it is Your full goodwill method should be given to parent and NCA. Step number 7 is what's a consolidated earnings. So add retain earnings of the parent company, add parent's post acquisition profits. But will you include the exchange gain or loss in retain earnings? No. You create, then calculate NCA, fair value of the NCA, post acquisition profit, less share of NCA in step 4 and step 6. Yes or no? Step 4 was what? Regarding your this one, what we say? Exchange gain or loss on net asset and profit. On the other, step 6 was what? On goodwill. If it is at fair value, we will give it. If not, no. Then step 9 is what? Translation reserve. This translation reserve will be recorded in equity part, and it will be include what? Parent share in translation difference of net asset. Step number 4 into piece percentage. Parent shares in translation difference of parent goodwill. Step 6 into the parent shares. Only in which case? Only in your fair value method. For full goodwill method, we will take the full amount here. I hope this is clear to everyone. Now see here on disposal what will happen. On disposal of a foreign operation, the cumulative amount of the exchange difference which has been recognized as OCI and accumulated to the parent such that they are accumulated in a foreign exchange reserve are reclassified to P&L. This was the question which I asked you at the beginning. It will be reclassified. It is a reclassified item. It's not a non-reclassified. It's a reclassified item. Where will you reclassify this to? Operating category. When once you dispose of the company. Partial disposal, only proportionate share of the related accumulated exchange differences reclassified to P&L operating category. I hope with this it is clear. Now foreign associate. If we have a foreign associate, what we do normally? Same. We do the calculation first in foreign currency, then we use the exchange rate. So cost of investment, spot rate at acquisition, then profit average rate, OCA also at average rate, impairment loss means at average rate. Then you get exchange difference. This exchange difference, the exchange difference is reported in the consolidated other comprehensive income as a gain or loss on the translation of foreign operations and allocated to owners of the parent. Yes or no? This will only be given to the owner, not to the NCA. It is accumulated within equity in a separate reserve and reclassified to P&L on the disposal of associate. Same thing. So with this, we have completed the foreign operations. Any doubts to anyone in this? The other two topics are not required, which are not tested. So with this, the revision of consolidation is done. We have taken good time. I hope each and every point is clear to everyone here. Yes, Sinchana, Sahil, Janvi, Natish.
Yes,
Yes,
sir.
sir.
Yes. So
So
with this,
that foreign currency consolidation, it will take a lot of time, right? So will the questions be this complex or will it be like,
I mentioned no, I have not seen a question where the examiner will ask you to prepare the full consolidated state. Either they'll do your work, they give draft version, no? So they will say what? Okay, a subsidiary is there. Already we have already translated each and every item and included. Some of the other items they would have not adjusted, like your exchange gain or loss. This you have to adjust and you have to explain there.
okay, sir.
As mentioned, whatever you know first in consolidation, do that. Do not waste more time because the adjustments, some adjustments will be easy. Do that and move forward. When we did in a regular class, a lot of questions, what I used to do, whatever we know first, we are doing that so that we get maximum marks. After that, do not crack your head simply wasting time where this will go, etc. If you're done, if you're 60 to 70 percentage, you have answered very well. Don't waste time because you can, instead of allocating the time here and simply wasting time to think, it's better to allocate to some other question where you know the answer and write down the points in your section B, question number 4. Because most of the students will not be able to complete the question paper, they waste time in consolidation. If you know all the adjustment, as mentioned, if your accuracy is good, you can give time, no issues there. But you should have surety that for sure I will get this much in this question. So with this part is completed. Now the last topic which we'll be doing is what? The cash flow part. That is also very important. Now, chalo, let us start with the cash flow. This will not take much time. Now statement of cash flow. Now is this important? Yes sir, the format of the cash flow has been changed, and the examiner has also mentioned that the importance for cash flow is more for the SBR. In which way? Consolidated cash flow. Now see here, now why it is important to prepare cash flow? It is important to prepare cash flow because profits and cash flow will never be equal. That is the first reason. So now chalo, let us start with the points here. What does cash flow means? Cash flow means inflow and outflow of cash and cash equivalent. Now sir, what does cash means? Cash means cash in hand. It's cash in hand here. And and demand deposit, that is current account. Sir, cash equivalent means what? Short term, highly liquid investment. Okay. If I have done an investment, let's take in bank, I have done a fixed deposit for 3 months. That also will be my cash equivalent. That also will be my cash equivalent. Because when will you say the following investments are cash equivalent? If it is readily convertible to known amount of cash, you know what is the amount you'll be getting back, and subjected to an insignificant risk of change in the value. The value will not fluctuate much. Then note, equity investments are excluded from cash equivalent unless it meets the definition of cash equivalent. 99.99% it is difficult to meet the definition or the criteria of cash equivalent. Bank borrowings are generally included in financing activities. However, bank overdraft balance are typically included in cash and cash equivalent. When you take a loan, you normally include in financing category, but the bank overdraft will be part of the cash and cash equivalent. So, what are the three activities in cash flow? The three activities in the cash flow are operating, investing, and financing. So, now what does operating means? Operating means the cash inflow and outflow from the main business activity. Then what does investing means? The cash inflow and outflow from the acquisition and disposal of long term asset other than cash equivalent, because cash equivalent will be the part of cash, it will not come under investing category. Then for financing activities sir, it is what the change in the equity value or the borrowing or the loans which you have taken. So now chalo see here, for operating category you have two methods, direct method, indirect method. For SBR, indirect method will be tested. So for investing activities and financing activities, direct method. So what does direct method means? Cash inflow minus cash outflow. And for indirect method, we will start our calculation from what? Operating profit. We will start our calculation from operating profit. First, it was profit calculation, profit before tax. Now here it is now operating profit. So see the format of cash flow. This is the format. It's a small format, detail we will study. Cash flow from operating activities you'll write down. Cash flow from investing activities. Cash flow means what? Inflow minus outflow. Cash flow from financing activity, you will get your net value. Increase or decrease in cash and cash equivalent. So you will do what? Add opening cash and cash equivalent, and you will say what is my closing balance. The opening value will be given in the balance sheet. Do this adjustment and check whether your answer is equal to the closing balance. If it is equal, that means your answer is right. If not, here and there mistake is done. Now see, cash flow from operating activities, indirect method. We will start from operating profit. What are the adjustments? For the first adjustment, you'll add non-cash expense. Non-cash expenses will be added back. You add non-cash expense, depreciation, amortization, impairment expense. Then if there is a profit or loss on the sale of PP, or if there is a profit or loss on the sale of a subsidiary, you should do the treatment. Why should we do the treatment here? Because this amount will be taken into investing category. Because if I say today my carrying amount of an asset is 1000, I've sold this for 2000, my profit is how much? 1000. But in investing category we directly write down the cash flow as 2000. So from here we have to remove this 1000 impact. So if it is a profit, we will reduce it. If it's a loss, we will add it. And same way for disposal of a subsidy. When you dispose of a subsidy, gain or loss you'll have, no? That gain you'll reduce, loss you will add it back. Then any investment income, you will reduce any investment income if it is included in operating category. Sometimes what will happen, no? Some income would be included in investment income, would be included in operating income, then you have to remove. If it is mentioned in the equation, consider. If not, no. Then increase in provision, you will add it. Increase in provision, because this is not a cash expense. Then government grant amortize, you will reduce it, because this government grant will be taken care in the investing category. I hope the first thing is clear. Then we do the adjustment for working cap, and very important adjustment, consolidated cash flow will come, 3 to 4 marks will be there for this, either in case of acquisition of a company or either in the case of disposal of the company. In the class we have done a trick so that you follow, that you will not go wrong. So now see here, increase decrease. If sir my inventory is increasing, that means a normal assumption is that I am paying the cash and purchasing the inventory. If my inventory is decreasing, that means my cash is increasing because I am getting cash. Sir, increase in receivable, if receivable is increasing, that means we will reduce it because we have done credit sales more. And then decrease in receivable means if your receivable is decreasing, that means we are receiving the cash, so we add it. Increase in payable, if it is an increase in payable, that means the payment is slow, that means cash is with us, so we add it. Decrease in payable, if your payable is decreasing, that means payment we are doing, so we will reduce the cash. So this will give what, cash flow from operating activities before income tax. So before income tax, so you'll write down this, less what, less you write down tax paid. Tax paid, only the payment amount, so you prepare your ledger account, T account, and see what is the amount we have paid, and you reduce, so you get what, net cash flow from operating activities. Now understand, interest expense in the previous format it was included, now it is not included, it is directly taken to financing activity here. So important note here, see, crux I have written here, non-cash expenses and losses we will add, non-cash income and gain we will reduce. If there is an increase in operating liability and decrease in operating asset, we will add it. If it is an increase in operating asset and decrease in operating liability, we will reduce. This one which I have discussed, working capital, that one only I mentioned. Then cash flow from investing activity. So what are the cash flow from investing activity seen? When you purchase any PP, so can I say it is an outflow? How will you get the outflow value? You have to prepare the ledger account. Then disposal proceeds from sale of non-current asset. If you dispose of, can I say you get the proceeds, we add it back, that is the reason the profit we reduce from above. Then government grant received, you will add it. Purchase of intangible asset, you reduce. Proceed from the sale of long-term investment, some long-term, you'll add it. Interest received, you'll add it. Dividend received, you'll add it. Any cash loan to third party, you will add it. Then coming to the next thing, net cash paid to acquire a subsidiary. Net cash proceeds from subsidiary. Whenever you have a question, either the question will be regarding a acquisition of a company or a disposal of a company. Now understand here the important thing, today parent companies are subsidiary companies there. Parent company paid $10,000 to acquire subsidiary company, but the subsidiary company has a cash balance of 6,000. So can I say on one way, in this way, can I say my cash is going out? On the other side, cash is coming in of 6,000. So how much is the net? So we say net paid to acquire the subsidiaries of 4,000. Same way for disposal, a parent company, subsidiary company. Parent company disposed of this company. That means when they dispose of, they receive 10,000. But this company had a cash balance of 3,000. So can I say ultimately how much? I'm getting 10,000, but I'm losing 3,000. So how much is the net amount I received? 7,000. I hope this is clear to everyone. Then cash paid to acquire associate. Whatever is the amount which you are paid to acquire any associate, you will reduce it. So whenever a question comes, consolidation, these three adjustments can come. Frequently repeated adjustments. And for sure, whenever you have cash flow, this time interest paid will come. Interest paid or interest calculation will come. Now cash flow from financing activity. So in cash flow from financing activity, what do we do? Proceed from share capital. Once you issue share capital, the company will get cash. We'll consider that. Then proceed from long-term borrowing. If you have taken some loan, in the balance sheet it will be mentioned the closing loan was 200. Now it is 500. Okay, that is an increase in the loan. Repayment of long-term borrowings. When you repay, you reduce it. In the balance sheet, you can see that the value of the loan is reducing. Payment of lease liability, you will reduce it. Equity dividend paid by parent. If parent is paying some equity dividend, it will reduce. Interest paid, you will reduce here. Dividend paid by parent. Okay, already I've written, it's repeated. Equity dividend paid by parent company will do this. So net cash flow from financing activity you will get. What you will get? Net cash flow from financing activity you will be getting. Till here, I hope it is clear to everyone. Still we have to come to the main point of cash flow. I'll come to that. As of now, the basic format we have learned. I've not come to the part SBR part. Only three items we have done regarding SBR. Now see here. See, this is the way you have to prepare your T account, ledger account to calculate the difference. So tax account, why we do? To calculate the tax paid. So current tax, deferred tax, opening, closing you record. During the year, what is the tax expense? And in OCI, whatever is the deferred tax you record, that you will consider here. And this side, if this balance is 100, this is 120. That means what? On the debit side, you have to do the adjustment. So 20 is the tax paid. This you will reduce from operating category, the calculation which we do. Then after this, for PP, what will you do, sir? We'll record balance brought forward, carry forward, opening, closing. Then any revaluation gain is that it increases the value of the PP. After this, any right to use asset it will add. Any depreciation that reduces the value. Disposal also reduce the value. You will do this. And then what will you do? Then what will you do? Then whatever is the difference will be on the debit side. That will be the asset purchase. So here, 1 minute. Oh, payment of lease up. Here, write down that. Here you have to write down the dividend payment by owners, dividend paid to NCA also, because we are preparing consolidated. No, this also will come here. Then next, government grant. Government grant, why do we do? So that we get to know what is the grant amount we have received, so that we can take into investing category. Then share capital, share premium, together we do. Why? So that we get to know what is the additional, amount that the company has, or the additional amount the company has raised, the amount which the company has received. Then retained earnings, why do we do for retained earnings? To see what is the amount of dividend paid, what is the amount for dividend paid. So balance brought forward, carry forward. Then profit for the year you'll add it, whatever the difference will be the dividend paid during the year. Then lease liability, sir. We'll write down the opening balance, closing balance, current, non-current. Then any new leases that you will write down, and whatever the difference will be your lease payment. This will affect your financing category. Then coming to the important adjustment for your SBR. 1, 2, frequently repeated adjustments. Now see here, everyone. Non-controlling interest. So for non-controlling interest, its balance is credit side, so we write down credit. So balance brought forward, whatever is the balance for NCA and whatever is the balance you bring forward and carry forward value of the NCA. Then what we do? Dividend payable, you will take that amount. What is the first thing you do? See, first ignore this. Do not consider this. Understand here now. First, you will take profit after tax. Yes or no? Whatever is the NCA profit, you will consider that better. Whatever is the profit for NCA, we will consider that. You consider it. After that, what we'll do? Profit and OCI percentage belonging to whom? Belonging to your parent NCA. Then what will you do? Is there any additional NCA during the year? Did the company, this is also frequently repeated. Now, parent company, subsidiary company. Parent company has a subsidiary. It has purchased 2 years ago. Now, if the parent company has acquired any subsidiary company during the year, that also should be included in this NCA account. That also should be included here. Then, sir, is this clear? Yes, this is clear. Then, sir, dividend paid. This is the dividend paid you will be getting. Now this balance brought forward will include what all? So this is the value of NCA. This is the value of new NCA. This is the brought forward balance. This will include what? The dividend payable also as a balance. Closing balance will include these two things. Whatever is the balance on the debit side will be the dividend paid. Now this dividend paid, where will you take? This dividend paid will be taken into what? This dividend paid will be taken into financing category.
Financing.
Okay. Chalo then. Next one. Associate and joint venture. Why should we do for associate and joint venture? If you remember, it's an associate. We have to record what is the dividend received. You will receive dividend from associate also, no? So we have to record that also. So now let us see the part in associate part. Investment in associate. Can I say it's a debit balance? So you'll have balance brought forward will include what? Investment, dividend receivable. You will record this value. Then you will increase the profit after tax value will increase. And if there is any additional associate, you are purchasing one more associate, you will increase the value, whatever the cost you pay. Then you have the closing balance. investment and dividend receivable. See, this investment which is there now will already include the value of dividend receivable. Then you'll record what dividend received. This side, whatever is the balance, that will be dividend received. This, where will you take? This will be taken to investing category as dividend received. Frequently tested, these are the two important things which are frequently tested in your cash flow for the adjustment part. So with this, we have completed this part. Now see here, acquisition and a disposal of subsidiary. When you acquire any company and when you dispose of a company, can I say what we do? Actual cash flow for the purchase of the subsidiary net of only any cash held by subsidiary. I mentioned that 1000 minus this example, investing category, investing activity. Now asset and liabilities in a subsidiaries are acquired or disposed. In that case, what should you do? In that case, what should you do? Now understand here. So see here the frequently repeated topics about dividend to NCA, dividend to associate, subsidy to parent, the net adjustment, acquisition, disposal. These are the four important adjustments. And the working capital ratios. These will come for 8 to 9 marks if a cash flow question comes. Okay, see here now. Let me explain you here only. Now today we say that a parent company is there, a subsidiary company is there. So now parent company has acquired the subsidiary company, acquisition. If the parent company has acquired the subsidiary company, what we do, we have to see the working capital part, your receivable, your inventory, and your payable. In this case, what will happen? Can I say this is the previous year balance sheet, 2000x3, 2000x4? Which one? Consolidated financial statement, consolidated financial statement. Now, the parent company acquired subsidiary company this year. If parent company has acquired the subsidiary company this year, can I say in 2000x4, the receivable, inventory, and payable will be included regarding subsidiary company? But will the balance be included in the previous year? Will the subsidiaries balance be included in the previous year? No, it will not be included. In that case, when you compare the receivable of 2000x4 and 2000x3, will this be like with like comparison? Never. It will not be a like with like comparison. So to make it like with like comparison, what will you do? To the opening also you'll add the balance. To the opening also you'll add the value. So see here now an example. M acquired C for this value during the consideration included. What is the payment they are made? This only question. No, 1 minute. Yeah, this one. So they are acquiring the company for this much, and the consideration is this much, and the share value is given, etc. XYZ. Then the net asset of C company is given. So M company is the M company has acquired C company, So subsidiary. So they have given the subsidiaries company net asset, inventory, etc. All the things they have given it. Okay, there are two payments, cash and share. No issues. Now see, show how the acquisition should be reflected in the group. So can I say how should we reflect this? Understand your point. Now for this one here, extract from the consolidated statement of financial position is given 2000x9, 2000x8. So now in 2000x9, can I say we have acquired the company? In that case, all these values are included here of the subsidiary. But in 2000x8, the values are not included. Then what will you do normally? You will compare the inventory. Can I say the inventory is increasing here? So if the inventory is increasing, can I say it is a reduction? How much is this? So we say 77,834 minus 99481. It's 21647. But is this correct? This is wrong, better, because this previous year is not including the value of the inventory of subsidiary. The comparison will not be like with like. So what should we do? See here now. Increase in inventory. Can I say 9948? That is the closing balance. Now opening is how much? Can I say opening was 77,834. Plus I will add again what is the inventory of subsidiary 938, so that my comparison will be like with like. So the increase is how much? Only 12,000. Same for receivable. Receivable is how much? 42,874. And this is 25,000. Can I say we will add further 15,000? So you will add it here. Same for payable, you will do 80,000 minus this. You will get this value. Here your payable is increasing, so you will add it here. So this is the way you have to do. This is the case for acquisition. Same will apply for disposal also. This was the question where we had done both the this was the question where acquisition also was there, disposal also was there. Now see here in this question, so see here now, a draft consolidated financial statement is given. They mention they have not done the adjustment you have to do. And increase in inventory, increase in trade payable, increase in trade payable they have given. All it is increasing. Now see here, they mention that they have disposed of the company. The disposal has been correctly reflected in the state in the draft consolidated financial statement. That means the disposal has been correctly reflected. That means in your consolidated books we have removed the asset and liability which belongs to the subsidiary company. Then a 70% holding in O had been acquired several years ago when NCA was measured using proportionate method. None of the goodwill arising on this was impact. After the acquisition, the investment of O is classified as an associate, so it becomes an associate. So at the disposal date, it had a fair value of 15 million. After the disposal date, the profit figure, everything is given. Now see here, the carrying amount of the inventory, the carrying amount of the subsidiaries is given. Plant and equipment, inventory, trade receivable, cash, and trade payable. So how much is this? 26,000. See here now. The statement of cash flow figures for inventory, trade receivable, trade payable, and property, plant, and equipment have been calculated based on the movement in the balance between consolidated financial statements between the start and at the end of the year. That means what they have done. This is my balance sheet. This is my whatever is the difference they have taken. Can I say this is wrong? In the previous year balance sheet, the value of the inventory was included, but in this year, it is not included because they mentioned that the balance sheet is properly prepared. Balance sheet is correct only. In that case, here they have removed. So the comparison is not like with like. So in that case, what should we do? Now see how much is the inventory here. The inventory is 3,900. 3,900. Now, when will you say your inventory is increasing better? When we will say inventory is increasing, your opening balance, your closing balance. Can I say my inventory is increasing when my closing balance is more? My closing balance is more. Now I say my opening balance is 10,000. Random numbers I'm taking. And my closing balance is 14320. So can I say if I take these numbers, can I say I'll get a difference of 4320? 4320, I'll get the value. Now, in this opening balance, this value is included. In the closing balance, the additional part is not included. The additional value is not included. If the additional value is not included, can I say we have to include it and prepare the balance sheet? The value is not included. We have to include it. So what will I do here now? In this case, what we will do? So now can I say here I will increase my this value. I will because in opening it was included, in closing it is not included. So I'll increase what? 3,900. I'll include the value. So how much is the value I'll get? 14320 plus 3,900. It's 18220. So how much is my difference? My increase in inventory should be 8220, but they have recorded 4320. Understood everyone? Follow this approach, you will not do mistake. Or either if you have learned some method where you have to add or reduce in case of acquisition disposal, no issues. Whichever way you feel, you can do it. For receivable, let me do for it. My receivable opening balance closing. Can I say the difference is of 8110? So I'll simply say it is 10,000 here. My trade receivable is increasing. If my trade receivable is increasing, that means my closing balance is more. So 8110. Can I say in this we had included the value of the subsidiary? In this closing balance, it is not included. We'll add it. So how much is this? 4,400. 4,400. So how much is the 18,8110 plus 440? It's 22510 minus this. So how much is this? This will come to 12,510. So you have to minus it here. Add minus sign 3,900. Here how much is this? 4,400. For payable, what should we do now? Let us, for payable, can I say my payable is increasing? When will I say my payable will increase? When we will say our payable will increase. Payable will increase when the closing balance is more, opening balance is less. So I say 10,000 here. It is 15,430. Random numbers so that the difference comes in. So I'm getting 5,430. Now see how much is the payable here. 5,900 my payable. The payable for the subsidiaries 5,000. So I'll add this 5,900 here. So how much is the value I'll be getting here? 15,430 plus 5,900. It is 21,330 minus 10,000. It's 11,000. So I have to increase this. So what will I do? I will plus here 5,900. Understood? How should you do? These are the adjustment for sure. Please do for acquisition, please do disposal. If you have learned a direct method, so for sir addition will be that we will subtract, we'll do this, etc. No issues. But if you're making mistake in that, follow this approach. It will be easy. So see here now. Subsidiary acquired. Subtract inventory receivable payable at the date of acquisition from the movement on these inventory when calculating the operating cash flow. Subsidiary sold, add inventory receivable payable at the date of acquisition from the movement on those in item when calculating the operating cash flow. So with this, the cash flow also we have completed. Any doubts to anyone? Audible? Any doubts, Satish?
No, sir.
No? So with this, we have completed the consolidation and cash flow part. And NPM and your IFRS 18, we have already done a revision session. So this we have completed. So with this, can we end the session now, Adish?
Yes, sir.
Yes. Okay then. Bye bye. Have a good day. Signing off. Radhe Radhe to everyone.
Thank you, sir.